Hello, am I live here? Good, thanks. So I'm Jeff Gordon, and on behalf of the Milstein Center at Columbia and the ECGI, I'd like to welcome you to this event on Rethinking Stewardship. This is a notable event in many ways, but certainly one of them is how we have attempted to convert some of the limitations of the present time, our inability to share a common physical space, into a strength, because we have been able to bring together a strong group of speakers in such a large group of participants that we might not have been able to assemble in what might be called the before times. Our speakers literally span the globe: Israel, Singapore, England, France, Brazil, New York, California, Washington State, and the sovereign state of Delaware. Often I've been at events with law professor presenters where occasionally we've had one or two participants, senior participants from the industry, but they are hard to get. Today we are fortunate to have senior folks from major asset managers and investors, approximately $18 trillion in assets under management, and senior advisors to this group. Apart from the potency of the Milstein Center and ECGI brand, who can resist the invitation to spend all or part of your day in a Zoom meeting? I suppose it does beat taking a plane flight. I want to call attention in certain ways to our co-sponsors and the Milstein Center. What's remarkable about the ECGI is that in less than 20 years, it has become a central player to bring together discussions and debates in the field. Yes, it's European, but as this event shows, it has become a central player and a facilitator of many important discussions that occur in the global space. The Milstein Center has its own pride of place, but it also shows how one visionary leader, Ira M. Milstein, can enlist, excite, and harness to good ends the efforts of others over a sustained period. I've worked with Ira at the Columbia Center for some time, and one steadily amazing and inspiring feature has been Ira's keen sense of wanting to know what comes next in the world, his openness to new ideas and constant concern about the future. To refer to a pop song of a few years ago, Ira is one of those who can't stop thinking about tomorrow. Footnote, Fleetwood Mac. So there are 775 signed up for this event, literally from all over the world. And it's great to be able to share the discussion we have today so broadly, and then afterwards to make available the recordings and the write-ups to facilitate further debate on these issues. It has occurred to me that these events attract such a broad following because they are in fact global governance discussions. Stock ownership exceeds, it goes beyond the national limits. Investors and asset managers of different types and different national origin are important shareholders in firms throughout the world. The economic performance of these firms and the local disruption that may follow from some of their decisions have become of first-order political importance in many nations. Although these firms are not created by their shareholders, such owners, especially if large and well organized, can exert a considerable influence. So, global governance consists to some extent in the rules, conventions, habits, and ways of thinking that influence how these large owners exercise their governance rights. The English Romantic poet wrote a famous essay in 1821, A Defense of Poetry, that contains his famous claim that the poets are the unacknowledged legislators of the world. Wow, that was a different world. For today, we'll give that mantle to participants at our discussion of Rethinking Stewardship. So the final order of business before turning things over to Merritt Fox, my Columbia friend, is to state the theory of the case. What does it mean exactly to rethink stewardship? Stewardship, by which we mean to refer to the behavior of investors and asset managers in their capacity as shareholders on behalf of a broad range of beneficiaries, has history. Here I give a US version in stripped down form. The performance of the US economy in the 1970s was subpar, the era of stagflation. US firms had been outcompeted by the Japanese in automobiles. Many US firms had morphed into diverse enterprises that made no economic sense. Some check and accountability for such managerial performance seemed required, but the shareholders were dispersed, collective action hard. So hostile takeovers appeared on the scene, costly, and of course, creating disruption in their wake. About the same time, in the 1980s, it became clear that a new investor class was emerging, a class that then consisted of pension funds, mutual funds, endowments, and similar investors. Many hoped that the reconcentration of ownership through these vehicles would lead to better oversight and accountability. The issue, however, was that the business model of the managers of many of these funds, the asset managers, did not fit with robust firm-specific monitoring and oversight. The funds were widely diversified, many firms in a portfolio, and the way that the asset managers were evaluated, relative performance to benchmarks and against peers, did not fit with the oversight goals. It's fair to say that the governance hopes of the reformers in that early period were disappointed. Matters came to a head in the events of 2007-09, in which outsized risk-taking by financial firms seemed to be a critical element in global financial distress. And then afterwards, the UK put a phrase that in common use, stewardship, into a stewardship code. But apart from its existence in code, stewardship was the call for this new class of investors and asset managers to step up to their responsibilities as owners. You might think of it as a kind of soft law. What does stewardship mean exactly? It's been taken to mean as engagement in a firm-specific way with the firms that are in the investor's portfolio. Diversified funds by construction hold hundreds, perhaps thousands of firms in the portfolio. What counts as adequate engagement? To what end? Is it to assure that managers are attending to the economic interests of the shareholders? Should funds of their beneficial owners be required to devote the resources to firm-specific oversight that may have little benefit for the fund as a whole? So the originator of the Stewardship Code movement, the UK, decided that stewardship required a rethinking. Engagement was not enough. It had become a check the box affair, but for two different reasons. First, the firms were not delivering widely shared, inclusive growth. And second, engagement alone did not carry a mandate with regard to a host of objectives that are compressed into the label ESG. But what elements of ESG should these funds pursue? And to what extent? And what about the economic goals of the beneficiaries? And what about the concern that Larry Fink or anyone sitting atop a large asset manager could become a modern king, a steward of the 21st century? A final piece to think about stewardship and stewardship codes is in the global dimension. Particularly in the US and the UK, these investors and asset managers have reconcentrated ownership that had in the past become highly diffuse. These owners are majoritarian owners. On average, about 70% of the stock in the biggest US firms is held in this way. But elsewhere in the world, that is not the pattern. Families are controlling owners, business groups controlling owners. These investors and asset managers are decidedly minority shareholders, yet countries adopt stewardship codes. What is that all about? All right, so I think we have a great day ahead. I'll turn it over to Merritt Fox to start us off and to run the show.
Well, good morning. It's the moderator for this panel, Index Fund Stewardship. We have as our main presenter, Lucian Bebchuk from the Harvard Law School. Lucian, along with Scott Hurst, has been doing considerable writing in this area, including a important article that appeared in the last year in the Columbia Law Review. And so he will give our principal remarks, and then our other panelists are Dorothy Lund from the USC Law School, Richard Lacaille from State Street, and Bonnie Sene from ISS ESG. We have a little bit unique feature with Dorothy. She went into labor last night, but she'll still be with us today. She had the foresight to tape her remarks in advance. We have no further news, but if we find something out during the day, we'll let you know. So with that, Lucian, if you can confine yourself to 20 minutes, and each of the commentators to between 10 and 14 minutes, we'll have a little time for Lucian to reply and perhaps some Q&A. So Lucian, take it away.
Thanks a lot. Do you see my slides?
Not yet.
Not yet. So let me
share screen.
Yes, just 1 second.
Yes.
All right. Yeah, sorry about that. So first of all, best wishes to Dorothy on this major stewardship effort for the new baby. And let me then present some of the key points of an analysis that, as Merritt just mentioned, we developed in earlier work. The first piece in 2017 put forward an analytical framework for what we view as an agency cost perspective on institutional investors. There are then the two recent papers that were circulated in the conference announcement, and Scott and I are completing a new paper, The Power of the Big Three and Why It Matters, in which we try to respond to and engage with a number of practitioners and academics that responded to our work. So what we try to do is to develop this agency cost view of index fund stewardship. We bring it to the data by piecing together both hand-collected data and publicly available data in order to form a picture of the full range of stewardship activities of the big three in particular. And we conclude and argue that the evidence is largely consistent with the agency cost view. What do we mean by an agency cost view of investment fund stewardship? It's a view that is premised on the uncontroversial assumption that stewardship decisions are made not by the fund's beneficial investors, but by the investment fund managers. Everybody would agree to this. The question is, how important is this? And our work shows that agency differences, agency problems are a first order driver of stewardship decisions in index funds. And you cannot really understand index funds decisions without examining the incentives of the managers. So when you listen throughout this day to various speakers who would put forward a view of what they think is a desirable stewardship on the part of institutional investors, we would argue that you have to think of whether this would be consistent and would be impeded in some way by the incentives of the index fund managers. Okay, now central to the agency cost analysis is to have a benchmark as a normative benchmark that you use for comparison purposes. And for us, the benchmark is the decisions that would best serve the beneficial investors of index fund managers. And those beneficial investors would be served both by some firm-specific improvements and therefore firm-specific stewardship, and also by some system-wide improvements and system-wide stewardship. You'll hear more about the second type in Jeff's presentation, since he's most concerned with the second type of improvements and stewardship. But from our perspective, both types of stewardships are included in our baseline because some of them is beneficial for the beneficial investors of the funds, and both of them, I will suggest to you, could be afflicted by agency problems. The two key agency problems are first, the underinvestment problem, and that's simply that index fund managers, as well as the managers of active funds, so this is not special just to the index fund managers, have incentives to underinvest in stewardship, and this is relative to what would be desirable for the beneficial investors. The second problem, and I want to stress it because to us it might be the bigger problem relative to the first one, and some of the commentators in this field who engaged in our work, we found that unfortunately focused on the issue of underinvestment of resources and time and paid insufficient attention to the second problem, which we label excessive difference. And that's the problem that index funds, as well as other investment managers, have incentives to be excessively differential to corporate managers, because not being excessively differential will impose on them private costs that they would rather avoid. Let me note that we recognize some constraints on the severity of agency problems. Those agency problems are somewhat moderated, but we explain in our work they are hardly eliminated by one, fiduciary norms. People want to do, quote unquote, the right thing. And secondly, reputational considerations. Let me mention the second, since recent discourse focuses on that. So index fund managers have reputational incentives, marketing incentives, uh, uh, various incentives to be perceived broadly as a good steward by their investors and others. Uh, and recent work stresses the ESG activities and the ESG rhetoric of the big three. We stress in our work that even though those reputational considerations and incentives are there and they are significant, incentives to be perceived as a good steward are very different than incentives to actually be a good steward. And therefore, the former cannot ensure that we will have a good stewardship. And this is the case here because of the limited information that many beneficial investors have about the impact of stewardship decisions. So given this limited information, and also the incentive to be differential to corporate managers, there are reasons to worry that we spell out in our work that big three stewardship, even in the ESG area, would produce more quote unquote governance talk and less results than is desirable for the beneficial investors of the big three and other index funds. Let me turn to the evidence. There are two parts to it, what the big three do and what the big three fail to do. What the big three do, first of all, we look at the investment in stewardship. We have to remember that as we document, each of the big three has hundreds of $1 billion plus positions in individual portfolio companies. And the size of that position, if you look at the numbers, could justify, from the perspective of the value of the portfolio, the beneficial investors, having multiple professionals dedicating a substantial part of their time to monitoring and interacting with such a portfolio company. So having, if you have a $1 billion position, saving several $100,000 a year to monitor and interact is not going to be wasteful, would be beneficial from the perspective of the beneficial investors. However, using hand-collected data, we show that the spending on stewardship for each of those big positions is not really economically meaningful. On average, it amounts to less than 0.2%, 20 basis points of the total fees of each of the big three. And this means that they could easily increase their stewardship resources by a multiple, increase them 5 or 10-fold without really requiring any material change in fees, which is something that everybody in this field would like to avoid. And if you translate the dollars into time, we find that on average, each of the big three is able to spend no more than 4 person days for each $1 billion position. So this means that each of the big three is able to devote only a limited and cursory review of the documents and situation for the vast majority of their portfolio companies in which they are a major shareholder. What else do the big three do? There is the private engagement that the big three often stress, that is central, and that this is a superior tool that enables them to avoid using other shareholder tools that sometimes they are criticized for not using. But we document that if you look at each of the last 3 years, each of the big three had any engagement, including even one communication, one single engagement with they had such an engagement only with a very small minority of the companies in which they were a big stakeholder. The incidence of private engagement was 11% for BlackRock, 7% for Vanguard, and 6% for State Street. And what this means is that for the vast majority of companies, there is no private engagement whatsoever, and therefore the possibility of private engagement cannot make up for the lack of use of other tools, to which I will be coming presently. Next, as to what the big three do, there is what we document to be pro-management voting. For example, if you look at the incidence of no votes on sale and pay resolutions, it's 3 times lower for the big three than for the largest actively managed family funds, mutual fund. I'm not talking about activist or pension fund investors, just mutual fund investors. And there is similar evidence in other recent studies. And this finding is consistent with the conclusion of our incentive analysis that the big three have an especially strong incentive to be differential to corporate managers, and therefore to avoid a pattern of voting that would seem non-friendly. Next, there is limited attention to performance. We argue that the beneficial investors of index funds would benefit from index funds paying attention when there is financial underperformance, monitor it and examine whether there are any easy changes that could be done to address it. This is firm-specific stewardship and monitoring, but that doesn't mean that it's not desirable. Doing it for the many companies in which you might have financial underperformance would be beneficial for the portfolio and would be part of what desirable stewardship should include. And we explain why it's not desirable for the index fund just to rely on hedge fund investors to monitor alone financial underperformance. But then we provide evidence that outside the context of activist hedge fund intervention, the big three pay little attention to financial performance, either when they make voting decisions or when they engage in private behind the curtain engagement. Last piece on firm-specific stewardship, everybody here would agree that in terms of fitness of a director to a board, it matters not just what some governance and process dimensions are, like whether they are independent or were chosen through some good governance process, but also on some individual and company specific, what kind of industry background they have, what kind of educational tools they have, and so forth. And these are things that the big three pay close attention to when there is an activist proxy fight. But we document that outside the small number of proxy fights, the big three pay little attention to such director characteristics in casting votes on director re-election. And indeed, by looking through the whole universe of Section 13 filings, we show that the big three avoid any communication with portfolio companies about the desirability of adding or removing particular individuals from boards. You can understand it given their cost structure and some regulatory barriers, but this is something that from a desirable stewardship perspective, it's unfortunate. Another and important for our purposes element of what the big three fail to do has to do with moving from firm-specific stewardship to system-wide improvements. That's what Jeff will be talking about as systematic stewardship. We argue that there are reasons to worry, and there is evidence supporting it, that the big three and other index funds fail also in this respect. To start, those who view index fund stewardship more favorably than we do, several papers are noted on this slide, stress that the big three, through their voting for some shareholder proposals and through their voting guidelines, contribute to some large-scale improvements in governance arrangement in many companies, say moving to annual elections or to majority voting. However, this view on the partly full part of the glass fails to recognize that the big three fail to fill the glass as much as the interest of their beneficial investors would warrant, and as they could readily do given their large power in the system. For one thing, the big three could easily obtain much broader implementation of the governance arrangements that they themselves favor in their own voting guidelines if they just didn't commit themselves to the differential approach of avoiding the submission of any shareholder proposal under any circumstances. We document looking at the whole universe of corporate governance proposals, and it's not surprising, but we just document it. It's not surprising given the policies that they have, is that during the past 15 years, including among the large subset of proposals that the big three always vote in favor, none of those proposals were submitted by the big three. And as a result of that, because individual investors have limited resources and holdings, as a result of this, there is a large proportion of the companies in which the big three are major holders and in which the company continues to have governance arrangements that the big three oppose. Another dimension in which there is inadequate suboptimal contribution to system-wide systematic stewardship, because they hold positions in many companies. If you have some beneficial wide-scale legal regulatory reforms, even if they provide a limited positive effect per company, contributing to the adoption thereof could be significantly beneficial for the beneficial investors of the big three. We hand collect evidence on the full universe of comments that were submitted to SEC rulemaking in the past 25 years, and on all the amicus briefs that were submitted in connection with significant judicial cases in our area. And we find that, consistent with the agency cost view, the big three, notwithstanding the fact that they hold more than 20% of the equities in the market, decided to stay on the sideline systematically in those cases, which we explain is consistent with their private incentives, but does not serve the benefits of their portfolios and their beneficial investors. Let me end on just a brief, maybe a positive note. I mentioned earlier that index fund managers have significant incentives to be perceived as responsible stewards. And therefore, in our view, to the extent that there is greater recognition by beneficial investors and the public of the incentive problems that we identify and of the evidence that we put forward, that by itself, this improved recognition can lead to improved stewardship. And therefore, we hope that our work and discussions like the one we have today will contribute to bringing about such changes. So many thanks for including us in this discussion. Thank you, Merit. I yield the rest of my time.
Okay, all 20 seconds. Well, that was perfectly timed. Thank you very much, Lucian. And in a slight deviation from alphabetical order, I think for technical reasons, we will start with the tape of Dorothy Lund and then move on to Richard LaCale and Bonnie, Sene, and if each of them can confine their remarks to 10 to 14 minutes, that would be perfect. Chris, if you can get the tape of Dorothy going. There we go.
Thanks so much to the Milstein Center and ECGI for convening this panel and including me. And I'd like to start by saying I very much agree with Lucian that the institutional investors that primarily invest in passive funds have incentives to underinvest in stewardship and be excessively deferential to management. I also think it's clear that the rise of passive investing has led to a massive aggregation of governance power in the hands of the so-called big three. And I think this concentration of power coupled with these incentive problems is likely to have negative consequences for corporate governance down the road. So in this way, I differ from Lucian. So I'm going to say more about these negative consequences, and then I'll tell you about how I think these problems could be addressed. So there are many reasons to be concerned about how the presence of largely passive block holders will affect the stewardship landscape. But I want to emphasize two main takeaways that I think we can draw from the very compelling evidence that Lucian has gathered. So first, Lucian's evidence suggests that the rise of passive investing is likely to result in a stewardship vacuum that's going to have negative consequences for company performance. So we know the big three only engage with about 10% of their portfolio companies each year. That's despite the fact that the term is broadly defined to include any communication with management, and despite the fact that the big three are often the company's largest shareholders. They're not engaging with the vast majority of the portfolio companies. And there's empirical evidence that suggests that a lack of engagement, a lack of monitoring from large shareholders leads to problems. So, a study by researchers at Booth shows that companies with their that had their largest shareholders distracted, those companies were more likely to announce value-destroying acquisitions and overpay their CEOs. In addition, passive fund interventions, to the extent they occur at all, might not be beneficial because of their lack of an incentive to devote substantial time and resources to stewardship and engagement. So the main governance tool employed by the big three is voting. And as Lucian's evidence highlights, their voting records are not always so great. And as they can grow to control a larger fraction of the votes, I think their voting may actually distort electoral outcomes in a way that's harmful for companies and their shareholders, and especially when it comes to the big ticket items, the highly contested proxy contests and the merger votes. So as just an example, consider how a stewardship group with little information or time would resolve a proxy contest. Imagine being bombarded with conflicting information, 300-page slide decks, phone calls, etc., about two very divergent courses of action, and then being asked to choose without much information about the company or management quality. And it's true that the big three's large stakes do provide an incentive to invest in information, whatever that voting decision could materially affect the stock price, which would of course increase the amount of fees collected. The problem though is that the institution is the one that benefits, not the individual staff and the governance team who don't have their compensation tied to the outcome of these votes in any way. Not only that, understanding that financial impact of a vote requires some information that the governance team might not have. There's also a strong incentive to defer to management in these moments. So voting against management in a highly contested vote is very likely to jeopardize the institution's business relationship. And that's a surer bet than guessing whether a vote against management is going to lead to a substantial increase in the portfolio's value. So like Lucian, I disagree that we can rely on activist hedge funds to tee up problems for passive investors to weigh in on. As the empirical evidence shows, passive institutional investors are very likely to vote with management, and in the rare cases they oppose management, we can't be particularly confident that they've come to the right decision. And just to take one example of these incentives at play, look at the DuPont proxy fight in 2015, where each of the big three sided with management, unlike most other large institutional investors who sided with the dissidents. And the big three's lack of support dealt a winning hand to management and caused the stock price to drop 7% when the outcome was announced. So to summarize, I think the rise of passive investing is particularly troubling for two reasons. I think first, the largest and most influential shareholders of companies are the least likely to monitor and intervene when problems arise. And second, when active shareholders attempt to intervene themselves, those interventions are less likely to succeed. So what's the solution if we think these incentives are compromising things, or will be? Lucian offers many interesting proposals that are aimed at improving index fund stewardship and also minimizing their conflicts of interest. And in my research studying index fund engagement, I've taken a different approach, and I've proposed minimizing the influence of index funds and governance altogether, such as by restricting their voting power. So at first blush, a limitation on index fund voting seems to be an extreme solution, but I think if you take a closer look, you'll see it's actually a less radical approach than encouraging index funds to be better stewards. So first, let me say a little bit about why I think encouraging investments in stewardship is likely to be detrimental. So as Lucian points out, the incentive to underinvest in stewardship comes from those very low fees that index funds charge their investors. So the solution contemplates raising the fees that investors would pay. And that fee increase would be substantial given the size of these index fund portfolios and the amount of resources that adequate stewardship would require. So I think this is a double-edged sword for investors who clearly benefit from low index fund fees and who might not be inclined to invest in an index fund if the costs were the same as those levied by active funds. It's true, of course, that investors are harmed from free riding, passive fund free riding, to the extent that it's going to worsen company performance over time. But the key point here is that not every investor needs to be engaged in governance to avoid problems. In fact, in many ways, it's optimal that not every investor, engage in duplicative research costs associated with voting and stewardship. The problem is when you have the largest and most influential shareholders who are not pulling their weight. And as I've described, this could lead to a dynamic where active investors are crowded out or not able to intervene successfully. So rather than try to force index funds to fight their incentives, which again would increase costs for investors and might not work as intended, why not permit index funds to free ride, but limit their influence when they do? So I'll say more about this in a moment, but first I want to highlight also that Lucian's solution would exacerbate a different problem, which has been dubbed the problem of 12 by John Coates, which is that as a result of the rise of indexing, we have concentrated governance power in the hands of a small number of unelected and unaccountable people. So if we regulate in the way that Lucian proposes, we'd leave the big three with even more power over time. So why not consider distributing power differently? And one option that I initially proposed would be to restrict passive fund voting, which would then leave governance decisions to investors that are better informed. And I envisioned a presumption that any fund that uses an indexing strategy would be restricted from voting or required to mirror vote. And that presumption could then be rebutted if the fund showed its governance group relied on meaningful portfolio company research or had access to information generated by active funds. So that rule could in fact encourage some passive funds to invest in adequate research, while others could simply choose to free ride. An alternative approach would be for companies to proactively issue a share class of non-voting shares for passive funds to buy. And this again would allow passive funds to free ride and would let better informed shareholders dictate voting outcomes. And either approach is going to avoid the distortions created by passive investing. But there's also some obvious problems. One is that if we had enough passive funds not voting, we could get a power vacuum where small idiosyncratic investors or insiders could easily buy up control. But that's unlikely to happen unless you take out a very, very large percentage of the vote. Even if half of a company's investors held non-voting shares, every remaining shareholder's voting power would double. So a 2% shareholder would become a 4% shareholder, and so on. And that's not enough to meaningfully change voting outcomes at most companies. But I think this concern gets at a deeper issue raised by Lucian and others who say, well, passive funds aren't great, but they're not worse than other investors, including actively managed mutual funds. And while I don't think active funds are perfect stewards, I think Lucian's analysis neglects 3 ways in which active funds have substantially better incentives to engage in stewardship than index funds. So first, stewardship is much more costly for passive funds than it is for active funds. So Marco Bex shows us in a new paper that studies the engagement activities of an active manager, that active funds are actually able to leverage firm-specific information generated by people trading, investment analysts, and they're using this for their stewardship and voting. Of course, they also have smaller portfolios, which means that the information acquisition is less expensive. Can reap outside gains from investments in stewardship in their competition with that's going to help them in their competition with active and passive funds. And finally, the conflicts of interest that Lucian identifies are more pronounced for index funds, which have fewer ways to differentiate themselves and attract clients. So for that reason, these relationships with portfolio companies are really important. Okay, so to summarize, although I know the idea of restricting index fund voting appears quite radical at first blush, I think it's actually the more conservative path forward. It would allow index funds to continue to operate under a business model that offers investors many benefits. It would maintain the existing status quo in governance where activist shareholders tee up proposals for relatively sophisticated but rationally reticent shareholders to vote on. It would minimize the problem of 12. And finally, it's also consistent with the economic theory that analyzes shareholder voting. The one share, one vote default has been justified as efficient because it's giving voting power to the shareholders that are best positioned to use it, which has been those shareholders with the largest stakes in the company. But when the largest block holders have the worst incentives to engage in monitoring, it may be time to revisit this rationale for an equal distribution of voting power.
Okay. I think that worked, and we'll have to send Dorothy our thanks when she's ready to receive them. So without further ado, if we can go on to Richard Lacaille from State Street. Richard?
Hi, good morning, everyone. I hope you can hear me.
Yes.
That was terrific, and I absolutely loved the presentation by Mr. Pepchuk. I think, as you would expect, I wouldn't agree with all the conclusions, but I think he certainly pointed out some interesting facts, and I think I'd like to respond to some of those from a State Street Global Advisors perspective as one of the big 3 as he would portray us. So firstly, State Street itself is a large financial services organization. We're a GSIB, regulated in many places. That embeds a certain caution within the philosophy of the organization as well. Notwithstanding that, we've had an asset management business for over 40 years, and it's been a little bit different to others. As many have pointed out, we've been a pioneer in indexing, and we're now one of the largest providers of index fund management services, as well as many others around the world. And with that has brought a little bit of a different perspective, perhaps from active managers, on this important question of stewardship and engagement. And maybe that's at the heart of some of the differences that might arise between perceptions or observations that Mr. Bebchuk would make and those from us who are actually undertaking asset stewardship. Maybe firstly, our viewpoint on ESG as an organization, we think that these extra financial, so-called extra financial factors are important, both in the running of our organization and as our role as an investment manager. We've embedded them in our investment processes. Obviously, they're embedded implicitly or explicitly in our asset stewardship and proxy voting. And in recognition of that, we were recognized by UNPRI as one of the 20 leaders from a PRI perspective. We're very proud to have achieved that. I think that was more about actual than perceptions, if I can steal the phrase from Lucian. I think we are accountable first and foremost to our clients for delivering on the long-term objectives that they have when they're entrusting their capital with us. And the voting power and engagement is an important part of that ingredient of long-term performance. I think stewardship as an index manager, as many have pointed out, is a little different. I think the discussion about resourcing is always a valuable one. Are we under or over invested in the amount of resources that we're putting into stewardship? But what we may all agree on is that stewardship as an index manager is a little bit different to stewardship if you hold a very, very small number of securities. And I think one thing that index managers are clear about is that their role, what their role is, what the role of the board is in relation to management. And I think sometimes in the discussion about stewardship, there's been a little bit of blurring of the edges. And some of the things that are suggested as legitimate aims for stewardship are really better described as roles of the board. So we think first and foremost, it's important that we have strong independent boards overseeing management, because first and foremost, it's their role to hold management accountable. Now, there are cases where obviously we need to hold boards accountable. They are in turn accountable for actions within the company. But I think index managers owning so many securities may place more emphasis on the sort of these sort of macro views of the investment process, rather than an active manager who has a very limited number of holdings, who may have important and valuable observations about the strategy of the business or where they want the business to go, by virtue of having a much higher dependency on a smaller number of securities. So with an index manager, in a sense, you own everything. You're interested in the performance of the market as a whole, how we can get competitive economies and therefore deliver greater shareholder returns. And the key to that often is in those very strong and independent boards, rather than focusing necessarily on individual firm-specific issues. And I think that's why maybe the resourcing is also a little different in terms of stewardship and governance for index managers than it would be for a manager who has a very strong dependency on individual firm results in a very concentrated portfolio. It's also worth pointing out we're still minority. I mean, we point out or it has been pointed out, the power of the big three. We are minority investors, or collectively our clients are minority investors, and decisions are not taken in, we don't dominate in any stretch of the imagination decision making from a proxy voting perspective. We also vote differently from one another, and those who've studied this, I think, have observed that the big three take different viewpoints on important issues, and I think it's vital that we retain that degree of independence. I think muddying together the big three and, in a sense, by implication, hoping for some sort of collective action, I think is very misguided, and I think leads us down the wrong track. So we're minority investors. We're different from one another. We focus on long-term issues. And an example of that would be perhaps some of the elements of ESG that we focused on that maybe active managers would say, well, in any given year or any given multi-year period, that's not the most important item on the agenda for that particular company. But when you own a portfolio of 1,000 or 5,000 companies, those systematic issues, maybe to do with the effectiveness of the board through diversity, for example, become much more significant. So it's a reason why it's understandable that active managers will focus on different things, perhaps rightly, from those who are managing across a much wider portfolio. They're therefore interested in more system-wide issues. It's a reason, for example, why Germany would be concerned about the tenure of directors and how we can have better board refreshment in Germany, because we think that's one way in which corporate governance, and by implication, by strong implication, long-term performance of German corporates would improve. Now, for any individual company, there will be issues to do with tenure of directors, but it's really the systematic improvement in governance that we're most interested in. I think the other difference, and we mentioned activists as well, activists often have very strong insights into individual companies, but they equally have a set of incentives that may not be congruent, to say the least, with very long-term investors who have very large and well-diversified portfolios. And so when you have activists approaching companies with a solution or an improvement, often there was an era where it was levering up the company, much more active sense of selling off a component. That may be the right answer for some companies, but it may be that we're guilty of being swept up into short-termism. And so as index managers, we have to be extremely careful to make judgments. And DuPont was raised as one a little bit earlier. We make judgments, we listen to both sides in that sort of argument. We involve our fundamental analysts, because I think in common with the rest of the big three, we also have fundamental active businesses that can also provide insights into those competing priorities when you've got a fork in the road, so to speak, from a corporate history perspective. And so we include them in the conversations as well. But it's not to say that hedge fund activists have got incentives that are not about value maximization, but the time horizon might be a little different. And again, we need to be a little bit careful about concluding that those who are very active have got it right all the time. We need to be a little bit humble about the role of activists in particular, and try to make good judgments about what works in the very, very long term. And that brings on to this measurement problem. I think a couple have mentioned already that how do you measure whether stewardship has been successful? We publish the results of our activity, but I have to admit it's very hard to measure. I mean, in a sense, the sort of type 2 error when you didn't intervene and couldn't is one that we certainly need to be focused on. But we also need to look at where intervention happened, or there was a desire by activists to have change happened, and frankly wasn't successful. If you look back at corporate history, certainly in the 90s, there was an era where activism actually was not helpful for companies. And in a sense, boards did need, in a sense, the ballast of those longer term investors to be able to resist some of the urges of short-term activists. There was perhaps a comment that, or at least a chapter of the discussion that I take more exception to, and that's the deferential to corporate managers. We're quite comfortable with voting against management, but we don't regard it as a badge of honor to vote against management either. And I think that there's a perception that if we vote against management, it somehow makes life difficult for us. We've done it. I've done it. I've been in conversations with boards, and we've voted against the board in a disagreement with them on some issue. And it hasn't damaged the relationship. Clearly, they know that we're a long-term investor. We're interested in the long-term health of the company. And the idea that that would somehow be an incentive for an excessive deference, it doesn't stack up. And I think from personal experience that I can understand why you might put that forward as an issue. But I guess my personal experience having engaged in this is that it really doesn't cut the mustard, so to speak, as an argument. So I think in conclusion, we have been active. We stand by our record. We publish our voting. We're different from the rest of the big three. We're proud of the differences and the resources we put in. But I think it's a really, really important debate. The question, how much do we put in? Is it too little? Is it too much? Do we become the apocryphal hammer that's looking for a nail everywhere he looks, or he or she looks? So in conclusion, I think index funds are different to other investors. They have a unique perspective, as they have a very, very long-term perspective. It means they focus on somewhat different things and need somewhat different resources to do so. And we're very happy to be held accountable by our clients for the actions we take and the resources that we put. And we'd like to be measured by them on that basis. So I look forward to the rest of the debate. And by the way, the questions that I've seen coming in I'm looking forward to having the opportunity to answer some of those as well. Some fantastic Q&A. Thank you.
Well, thank you very much, Richard and Bonnie. If we can move on to you.
Absolutely. Thank you so much, Merritt. Great. I hope everybody can see my screen. Before I get started, just a few comments following on Richard's presentation. First of all, it's an honor to be here with everybody today. I would actually agree very much with Richard on several of the comments made, specifically as it relates to votes against management. One of the things that I would like to do is share some independent ISS ESG findings based on voting execution by the big three, as identified during today's session. I'd also like to set up sort of the industry framework, what we're really facing today in terms of ownership and trends that we're beginning to see from a market perspective. I'd also like to propose a possibly an independent solution that is neither costly, I think, as we've identified by today's discussions, or restrictive in terms of exercising voting rights. In addition to that, I'll share some information as it relates to voting trends and behaviors. And I think the key here is that, focused engagement will be critical ultimately, and ensuring that we have long-term stewardship execution. So with that, let me go to the next slide. All right, so effectively what we see here are some interesting data points. The US ESG ETF market currently represents approximately 37% of the combined daily volume of all US stock exchanges, and is expected to reach 5.3 trillion in AUM by year end. More than 80% of all assets that have flowed into investment funds in the past decade have gone into index funds. 98% of all of the ETFs today in the market are passively managed. US ETF assets have been growing roughly at 25% annually over the past decade. And the top 5 ETF sponsors, BlackRock, Vanguard, State Street, Charles Schwab, First Trust, preside over 80% of the total assets today in the ESG market. The ETF, the broader ETF markets. Between 2014 and 2019, 5 of the 10 largest fund families voted against more than 88% of ESG-related shareholder resolutions. But let me put that in context as we discuss some of the findings later in the deck. If we look at the concentration of assets in ESG ETFs, the top 6 US-focused ESG ETFs have approximately 16 billion of AUM. 23% of that total AUM from the 6 funds is allocated, across the 11 holdings that all of the ETFs own. 41% of the total AUM from the 6 funds is allocated across 31 holdings. 50% of the total AUM across 6 funds is allocated across 60 holdings. And then we'll get into the importance of why this concentration across ESG ETFs specifically will be important as we think about it through a stewardship context. Let's talk about different examples of stewardship. So if we look at specifically stewardship today, there is what we call delegated stewardship, obviously not a best practice. Delegated stewardship refers to outsourcing of proxy voting and engagement services to third-party providers. We do see this in several cases as it relates to voting and taking voting actions against conflict of interest, identified conflict of interest situations within asset management shops. In some of these instances, a portion of stewardship activities such as engagement would be managed externally through a third-party agent. Let me just also share a context here. I spent 20 years in asset management before moving to ISS ESG, so actually building out the responsible investment platform. So do bring some aspects of both, really solutions providers as well as asset management approaches. Now, let me get into decentralized stewardship, which I think is an interesting concept that I'd like to explore. a little further today. Decentralized stewardship, quite frankly, is probably one of the most complex and difficult, I think, to build and monitor internally within an asset management organization. But as Richard had mentioned, each of these big three have fundamental active equity analysts, and there is a unique opportunity to really leverage that expertise in a more meaningful way. And so a decentralized model effectively refers to direct alignment of voting engagement facilitated exclusively by the fund managers on the active equity side who are making buy-sell decisions. So in the case of index funds, this process could be applied through a proportional or majority voting application. So essentially what this means is that fundamental active equity managers within these organizations are making these decisions, they're engaging with these corporates, and then they are able then to echo or mirror that vote against the passive shares across the organization. So it's a very interesting concept. It's one that has worked successfully in a few firms, and I think one that ultimately may provide an interesting input and solution, again, that is neither costly nor restrictive as it relates to voting execution within the big three. The other topic is centralized stewardship, referring to how an asset manager organizes both engagement and voting through a centralized stewardship team. So, as we know, most of these conversations have really centered around some of the issues related to centralized stewardship. I would argue that these teams have continued to build and facilitate very strong engagement, and we are seeing results of that, specifically as we have seen this marked shift to responsible capitalism. I'll talk more specifically about what that looks like in some of the voting outcomes. These firms are typically will typically apply one vote, all shares approach, and typically will centralize all stewardship activities. In some situations, we do also have hybrid stewardship. So a hybrid stewardship function consists of elements of both delegated and centralized or decentralized decision-making for the execution of voting and engagement. Could certainly involve committees comprised of stewardship, compliance, legal, operations, and investment personnel. These committees are generally constructed to not only, to only identify outliers based on a principles-based framework. So not necessarily looking at the entire universe, but certainly those that are identified as problematic based on signals using both corporate disclosure as well as alternative data sets to identify controversies. If we take a look at how companies are being assessed today, there was a very interesting report that was released really assessing the stewardship capabilities of the big three. What they looked at was proxy voting policies, practices, and records, and engagement policy, practices, and activities, climate policy adoption and execution, which, as we know, alignment to the TCFD is now a requirement of the principles for responsible investment, as well as stewardship resources and operating systems and disclosure. So, really across all three, and I won't go through specific detail as I think most of it is captured here, but we do see that there is a tremendous amount of, again, what I would call very engaged dialogue with corporates, and this is all actually published within their annual disclosure, their stewardship disclosure report. So we are beginning to see, I think, distinct movement and what I would call again, this shift to this responsible capitalism away from primary shareholder primacy models that we've experienced in the past. Some interesting patterns. So the vast majority of proxy proposals, and I think it's important to take a very focused approach as we think about this entire topic. The vast majority of proxy proposals today are routine management proposals. Shareholder proposals only account for about 2% of all proxy proposals. So that's number one, a very important, I think, point to really underscore here. If we highlight, for example, just BlackRock in this situation, we'll talk more specifically about State Street and Vanguard as well. But BlackRock's votes against 728 overboard corporate directors just in 2020 this year really indicates a jump of about 69% between 2018 and 2020. So we are seeing considerably more active approaches as we consider sort of the opportunity to exercise voting rights and take and draw a line in the sand as it relates to directors. About half of all shareholder proposals are sponsored by a small handful of individuals or organizations. And in 2017, approximately 65% of ISS recommendations were for shareholder proposals, compared to approximately 35% of funds voting for votes cast. I will tell you, having come from the asset management side, though, you really have to look at shareholder proposals not from a blanket perspective, but in terms of, quite frankly, their materiality and links to, frankly, the opportunity of these companies, again, to deliver, and build long-term value creation. And so not every shareholder proposal has merit. And I think that's an important topic that really needs to be underscored here. In addition, ESG ETFs had consistently voted against at a rate of above the overall firm vote rate, but in 2019, for the first time, actually dropped. Fund houses are getting better at identifying poor compensation practices as well. Really quickly, just want to discuss a few things around voting trends. According to an independent ISS ESG study over the last 5 years, investors have demonstrated fewer against votes on management say on pay, but actually more against votes on director issues, particularly with companies of no women on the board. So director elections as it relates to diversity, and we continue to see a very strong collective in terms of really helping to push greater diversity across directors holding these seats across corporate boards. Also, according to this study, State Street Global Advisors most actively votes. So Richard, back to your commentary earlier, most actively votes against management on director-related and management say-on-pay proposals. Vanguard is singularly the most active on management say-on-pay proposals, as indicated by this study as well. And just wanted to leave everybody with this as well. It's interesting. There's a great piece presented by Elroy Dimson and Ozan Karakas that really talk about the power of coordinated engagements, from Cambridge University. Really they discuss what they call their two-tier engagement strategy, so that when you have a lead investor, who is leading the charge on an engagement and supported by smaller investors, from international markets, so the lead investor has to be located domestically. They were seeing, success rates distinctly elevated, financial and accounting performance improved, and lead investors, again, really helping to drive sort of what we call this investor coalition. So with that, that is my discussion points that I wanted to share today. And thanks again for the time.
Well, thank you, Bonnie, and thank everyone for staying on schedule. It leaves us about 10 minutes till we'll take a break at 10:55 Eastern time. So Lucian, let me just give you a couple of minutes to, if you'd like to respond, and then we have a little bit of time, we can take some Q&A.
Yeah, thanks a lot, Merit, and thanks a lot for all those very interesting and valuable reactions, and we'll try to engage with them in the new paper that we are writing that tries to engage with new different views. Let me offer quickly just a reaction to each of the commentators. There's obviously a lot in those comments. To Dorothy, we share concerns. The reason why Scott and I don't go in the direction of willing to consider taking the vote from index funds is because our analysis indicates that active funds and retail investors are not necessarily better. Indeed, there are various factors that go in the opposite direction and that might make some of index fund voting more informed. It's a complicated area. We have this analysis in the paper, but because we don't really reach the conclusion that the index funds are generally worse, and indeed that they are often better than some other shareholders, our approach is, to paraphrase Mark Anthony's, we don't want to bury index fund voting. We want just to improve it. To Richard, and I think also to Bonnie, one reaction. So you mentioned a lot of things that the index funds are doing. This is obviously a complicated area, and this is a massive operation, and obviously there are lots of things that are happening, and the question is, how do you evaluate them in terms of, do we have a sufficient shortcoming to raise our concerns? And I would, just to pick up one that I mentioned in the slide, but let me stress again, there are various arrangements that clearly the big three would like to see happen. They are all in favor of majority voting. They are all in favor of eliminating supermajority provisions. We can all, within few minutes, download the names of hundreds of companies that still have arrangements that the big three are strongly against. I submit that the big three, having more than 20% of the shares in all those companies, if they wanted to, they could get those arrangements. They could submit a proposal and get it to happen. Indeed, if they were just willing to send a letter and say, if you don't follow this, we would view you as informally as having failed, and we would have the same consequences as if you didn't follow a shorter proposal, it was going to happen. So there, sure, kudos to various things that the big three were able to happen. But as an academic look at it from the outside, there are very big fractions of the glass that remain in a way that is concerning to me empty, and that I think the big three could easily get filled. And the last reaction, and that's to Richard. By the way, Merit, I also have reactions to the various comments that came through the chat, if you will want me to respond to them later. There is the question, and I understand this, the tendency to say our model, our business model, doesn't enable us to follow financial underperformance, given that we have hundreds of companies. Now, partly is what academics call endogenous. It's a question of, and obviously the big three have the resources. If you wanted, you could, get stuff. The question is the following to me. When a hedge fund activist comes and raises the issue of financial underperformance, you look at it and you make a judgment call whether this financial underperformance merits the governance changes that the activist calls for and so forth. And from the point of view of beneficial investors in the big three, and I am one of them with my own retirement account, I would prefer, and I think it would be in my interest, if you have some sort of a system that even if an activist hedge fund doesn't show up, if there is a systematic financial underperformance, it elevates it to someone who looks at it, has a conversation, looks to see whether there are some governance improvements that could be made and so forth. So I think that's something that could be done. And I know what are the impediments to this happening, but from my perspective, the question is whether those impediments are consistent with optimal stewardship. Let me stop here before Merit gets upset.
Never. So do either Bonnie or Richard want to respond to anything that Lucian has said?
Richard, I'll let you.
On that. Sorry, Bonnie, go ahead.
No, I was going to say Richard, by all means.
On that last point, we do have a filtering mechanism which does focus on financial underperformance of companies as a trigger for more, I don't want to call it investigation, but analysis, engagement. So that absolutely does happen. Now, whether it happens in the same way or with the same intensity as an activist hedge fund is a fair question. But that is one of the drivers internally, and that's how we prioritize our resourcing within the asset stewardship team.
Yes, a quick reaction to this. One thing that you don't have, and I, as a beneficial investor, I would like to see, is if you look at the voting guidelines that you and the other big three provide, which are very helpful, you see a very long set of reasons that would provide you to withhold support from a director, that get you dissatisfied in one way or another. And financial underperformance, which to many long-term beneficial investors is very important, doesn't get, and it's not State Street, it's the big three in general. If you look at the voting instructions on withhold, they are so much governance focused, and financial underperformance is not that significant there, if at all. But let me stop here.
Yeah.
Bonnie?
Because the guidelines around directors are specifically on governance related issues. It doesn't mean that there wouldn't be a vote against a director based on financial underperformance, but first and foremost, that's the criteria that we've drawn up.
Right. So basically you have the lever, which is a very important lever. We know the directors very much care about it, if you might withhold support. And that particular lever is used for governance purposes and less for sending signal on financial performance. Now, this is not a secret. We all know that the big three are focused on, governance. And you were saying that you believe that good governance will provide a foundation then to financial performance. But the question is that indeed the optimal level of stewardship? But this is something we can continue discussing.
Yeah, Bonnie, just if both you and Lucian could be quick, because we're supposed to cut off in a minute or two.
Yeah, no, I think all of, I think what I would say is that the engagements inherently are really geared towards long-term value creation. It's the ability to signal what may happen specifically. So it's not just taking a look at current and existing underperformance within a company, but it's also looking at the ability to signal and identify, so forward-looking scenario analysis that helps to identify that, whether that be through top line growth, it could be through cost reductions, material costs, for example, to carbon and water, regulatory or legal implications, investment optimization. I mean, there's a number of different things that I think, would be and provide sort of critical, meaningful basis for engagement long-term.
Okay, I think we should leave it at that. I'm sorry that we didn't have time for Q&A, but we had a very vigorous discussion with lots of ideas. And so the powers that be say we have a 5-minute break, and they're supposed to start again at 11 a.m. Eastern time.
Thank you very much, Merit.
Thank you, Merit.
Thank you.
Thank you.
Hello.
Hello.
Um,
Yes.
Hi, Jeff. I'm here
Hi,
too.
Ron.
I sent you a quick note that asked, what would you, what do I need to do to run, to make this thing work when we're running the panel?
Basically, I just think saying our next speaker is.
Oh, and they then they share their screens. That's fine. I'm
Right,
capable.
exactly.
I'm capable of that.
Yeah. I don't think this is rocket science. Hello, Teresa.
Oh, can you hear me okay?
Yeah.
Okay, great.
Ray, it's a pleasure to see you. I'm so glad you are participating in this.
Thank you, Jeff. I'm happy to be here to represent the firm. Should be an interesting discussion.
Yeah. We have to get to know you better. Okay, well. So let's see. We have New York and Philadelphia and Bill. Where are you now physically? You in New York or Philadelphia?
No, I'm in Philadelphia. So 12 miles west of the city in bucolic Wayne.
Yeah.
So Jeff, are you gonna? Can we like turn this whole thing back to you and have you reconcile your views with Lucian's?
Well, actually, Lucian both punted, but didn't understand actually the way we're different, which is to say, it is certainly the case that funds pursue portfolio-wide strategies. But my claim is that in general, they are strategies designed to improve expected returns. What's distinctive about the claim I'm making is that there's a completely different set of strategies which are designed to reduce systematic risk. So for example, on gender-related stuff, which is often, a portfolio-wide concern, from my perspective, that's just expected returns, right? There's a talent pool that's out there that's not being utilized. Firms would be managed better if it were available and utilized. So that's an easy one from the point of view of just purely expected returns. It's not systematic. It's not in a portfolio theory sense designed to reduce systematic risk. It's just similarly the argument about classified boards versus or dual class common stock. These are just features in which firms on average will perform better or not. And so in effect, the economy will perform better or not. But that's quite different from focusing on systematic risk reduction in the sense I'm describing, which involves focusing on a particular kind of risk, the materialization of which could be disastrous for, in effect, the whole portfolio because of the way, for example, a financial distress or a climate change break is going to reduce values across the portfolio. And so that's kind of what's distinctive. I don't think the financial economists have really focused on this in a very good way in asset pricing models because there is a separate discussion. They have, the factors that go in, but then there's a separate debate about, in effect, the rare disaster stuff, which seems to be, at least in the eyes of some, extremely important because the equity that word's not going to come out.
Pricing.
Right, exactly. An extra amount of the stock price is associated precisely because of the risk associated with the overhang of
Black swan event.
Right. So anyway, but that's not going to be the major thrust. It's going to be about the point is Lucian didn't get the point. Of course, these funds will do stuff that will increase expected returns across the portfolio, but to try to understand what ESG is doing is really from, it's a bundle of different things, some of which are about expected returns, some of which are about reduction of systematic risk. And from my perspective, they have to be analyzed and defended in different ways.
Jeff, we should
gotta
get
get
going.
the show on the road, right? Yeah.
You bet.
Okay. All right.
Now, do we have everybody signed in? The host has spotlighted your video for everyone. Well, good morning. We have a fascinating session. Jeff Gordon is going to talk about a role for institutional investors playing as stewards that is not familiar in the literature and was not covered in the first session. And we've got a remarkable panel to do this. For things like this, it's really very useful to have both the Beatles and the entomologists on one panel. We have representatives of two of the three largest asset management groups. We have a $145 billion state pension fund represented. On the small side, I've been the independent chair of a family of mutual funds that on a good week is probably around 200 billion. I want to take the 2 minutes I have, and everyone should take a look at the program because the panel participants, quite remarkable careers are described there. I want to take just 2 minutes to talk about the dynamics of the asset management industry. What we have a tendency to talk about the industry as if we were taking a snapshot. The industry is in my view, is in the process of a significant change, and that change is consolidation. And if we just look over the last, 6 months or so, we've got Franklin Templeton and Legg Mason combining, generating roughly $1.2 trillion of assets under management. You've got Morgan Stanley getting back into business by buying Eaton Vance, another $1.2 trillion. Nelson Peltz has taken roughly a 10% stake both in Janus Henderson, who had combined 2 years ago, and Invesco. That'll generate another $1.2 trillion block of assets under management. Wells Fargo announced yesterday that their $578 billion worth of AUM is on the block. And Jamie Dimon, not to be left out, 2 days ago announced that while they don't have anything on the table, they're looking at acquisitions. That's asset under management. If you also think about the other side of the business, the distribution channels, just as an example, Schwab's acquisition of TD Ameritrade was approved by the Justice Department. So it's not just that the first derivative of concentration is positive. The second derivative of concentration is also positive. And that background, the conversation about stewardships, the conversation about what institutional investors do, at least needs a background, the simple background of what's going on in the industry that all of them are engaged with. So what we're going to do, Jeff, you have about 20 minutes. Then each of the commentators will have 10 to 12, and then we will have some time left for Jeff, for you to respond and to engage questions from the others of us who are here.
Great, thank you. Let me see about share screen.
Thank you for doing that, Jeff. I'd have messed it up.
Okay, let's see. Is that working to, anyway,
I can see it.
okay. I hope, oh, there. I hope that's good enough. Okay, so got a two screens set up here. So the slide has really got the talk in a nutshell. Oh, wait, here's the intro. Oh, right, that's the title. Now, the goal of what I've written is to provide a foundation for a form of engagement by large investors and managers with their portfolio firms that both fits their theory of investing and their low-cost business model. And I call this approach systematic stewardship. The obvious audience is the broad-based index fund designed to follow the performance of the market as a whole while minimizing fees, even zero fees. But systematic stewardship can also serve as a guide to any large investor where it's pursuing a strategy of wide-scale diversification and to reduce cost as much as it can. So the core idea is this. The insight of modern portfolio theory, which is really the foundational strategy for asset management, is that investors' utility takes count of both risk as well as expected returns, so that what investors want to maximize is risk-adjusted returns. Therefore, investors compete to create diversified portfolios to eliminate risk and are generally paid for bearing only that risk which cannot be diversified away. The risk that pertains to a particular firm, so-called idiosyncratic risk, can be diversified away. Risk that will affect returns throughout the portfolio, systematic risk, remains. So this is a critical difference with some of what the prior panel discussed. Engagements that may improve firm-specific performance generally are idiosyncratic. They will not improve the performance of the portfolio as a whole. Now, the possible exception requires the assumption that such engagements are part of a pattern designed to produce what I call governance externalities that lifts the performance of all firms on average that will produce economy-wide effects. The straightforward implication of this is that advisors of extensively diversified portfolios, especially the broad-based index funds, should focus on addressing the systematic risk elements in their portfolios rather than new efforts into firm-specific performance-focused engagement. Now, this can mean different things. It could mean voting in support of a management of a systemically important financial firm in a face-off with hedge funds who want the firms to take greater risk to enhance the shareholders' return. As the events of 07-09 vividly illustrated, the failure of a SIFI can result in losses across the entire portfolio. In deciding whether to support the risk-loving hedge fund, the index fund investor ought to consider not only the return proposal at the single firm, but the systemic risk effect. Because portfolio theory shows us that investors in the index fund are seeking to maximize risk-adjusted returns, and so that assessment of systematic risk effects become even more important in this case than the impact on single firm returns, an idiosyncratic effect. So a salient form of systematic risk, of course, is climate change risk. The disruptions associated with various moments of this risk will reflect across the entire economy, across an entire diversified stock portfolio, climate change risk is systematic, and failure to reduce it will thus reduce risk-adjusted returns for an index fund investor. So here is the importance for a portfolio theory perspective. Many arguments for a climate-sensitive engagement entail a trade-off between expected returns and the social value of avoiding the potential for severe harms. Socially responsible investing. Systematic stewardship grounds engagement to reduce this risk in the economics of investor welfare. The goal of such engagement is to lower systematic risk and thus to improve risk-adjusted returns for the investors in the fund. There is no trade-off of investor welfare for social welfare. Now, in a sense, there's nothing new in the claim that diversified investors should and do, in fact, take a portfolio approach towards their engagement activities. For example, such investors have developed a model of good governance expressed in guidelines that generate voting positions across the entire portfolio. For example, these investors commonly reject classified boards, want annual say on pay, want a single class common, and sometimes supported by empirical evidence, and other times by just a view about the managerial accountability to shareholders. Such investors believe that the adoption of these positions will increase the value of the firm on average. And then these views are applied in a relatively uniform way across the portfolio, even though a firm-specific analysis would surely produce governance heterogeneity to a greater extent than we see. Surely some firms would benefit from relative stability associated with a staggered board. The typical response is yes, bespoke governance might be better, but given the cost, including follow-up monitoring required by such tailoring, it's the uniformity approach that will increase expected returns across the portfolio as a whole. Now, systematic also takes a portfolio approach. The distinctive twist is the focus is not on how to increase expected returns across the portfolio, but how to reduce systematic risks and thus how to enhance risk-adjusted returns across the portfolio. It's not just an additive approach. Indeed, there may be a trade-off with expected returns. Going back to the SIFI case, a diversified investor caring about systematic risk may have a different approach to risk taking by a large financial firm and may favor rather than disfavor government rules that constrain that risk. It may regard its risk-adjusted returns as enhanced rather than reduced by measures that reduce expected returns across that part of the portfolio. In short, systematic stewardship provides a finance-based framework for the assimilation and assessment of many concerns that fly under the flag of ESG, environmental, social, and governance matters. And some concerns, climate change, for example, get quick take up by systematic stewardship, sorry, but others perhaps not. And so a systematic perspective will be a framework to analyze in a more specific way those parts of ESG that maybe a fund should focus on and otherwise not. So the claim here is that the stewards of diversified funds should devote their engagement especially to thinking about the portfolio-wide effects and especially systematic implications in their use of the governance tools. But it's not only an obligation from the beneficiary point of view. and their comparative advantage because it actually fits with the economic core of their investment management strategy. But insofar as investors are drawn to funds that advance ESG concerns while not giving up on risk-adjusted returns, the index funds may find that it's a persuasive point of competitive advantage. Asset managers can market their systematic stewardship stance as a way of trying to distinguish themselves from other index funds and thereby to increase assets under management. So again, I just want to, on slide 2, the critical point for me is there is not a trade-off from doing well and doing good in this sense. Once you take account of systematic risk and the importance to reduce it and thinking about risk-adjusted returns, we're not dealing with socially responsible investing, but finance theory in the effort to improve the welfare of the investors in the portfolio. So, I've got limited time. I want to focus on a few things. One of which is the connection is about systematic risk, and basically part of the point here is that the CAPM model does have, even in the various versions of it that add more factors, FAMA, French, et cetera, it still has a sort of a market risk element to it. And part of what I suggest by way of actions that index funds can take is the effort to force disclosure, whether at the individual firm level or even through the SEC, to force disclosure on various activities in which the firms engage in that affect the systematic risk that they bring to the party and also the extent to which they're affected by the systematic risk. If there's better disclosure, then we can get a better price for these firms. We can get systematic risk priced in a more specific way as to the systematic risks in question, and thereby the market itself will bring pressure on these firms to reduce the systematic risk that may exist within the way that they do business. A second point I want to make here is the case against index fund engagement in firm-specific stewardship designed to enhance the performance of the firm. The key point is that an index fund, unlike an actively managed fund, can't achieve a return by firm-specific performance engagement. By definition, if you've diversified fully, then any performance change is going to be idiosyncratic. It's not going to move the needle, and it will not be valued by investors. It won't improve the performance of the portfolio. And so, that's thinking about Professor Lund's point, that's a complex issue, but I think it has to be appreciated. And for example, there's an example of potentially an intervention against Apple, a large cap stock, obviously, which is going to have performance effects, and that in theory ought to provide, if you have 5% of Apple, that's a very large amount of money, a 5% improvement in the stock price. Well, that's meaningful. Your fees ought to go up because the AUM ought to go up. It doesn't work that way. if the portfolio is diversified, most of the gains associated with Apple are going to come at the expense of Google or, you know, Microsoft or Intel. And so you actually are not going to be able to improve the performance of the portfolio as a whole. The second point is that the index funds can take the beneficiary, are the beneficiaries of, in effect, a governance ecology in which they can afford to be responsive, not active, but responsive, reticent, as Ron and I put it once, with respect to performance proposals that are teed up by others. The index funds have no comparative advantage for firm-specific performance engagement. The hedge funds, who devote incredible energy to figuring out specific funds, have that comparative advantage. At most, the index fund should be responsive to these other proposals. And the critical point here is that of governance externalities. Implicit in Lucia's claim is that there is an undersupply of this sort of stewardship. I don't see the case for that. If anything, we think that the governance pressure that already exists in the market leads firms to behave in short-termist way. I'm just not. I disbelieve that asking the index funds to do that would improve the state of the world. So, what are the kinds of risks that count as systematic, perhaps? One of which, of course, is climate change risk. Another of which is financial stability risk. And another is social stability risk. I don't really have time to unwind the story. It's there in the text, which you can look at. But the key point is modern portfolio theory, diversification has transformed not only the way investors invest, but how firms are structured. And the shift in structure, which means firms are not really diversified, but are focused, means that there has been a risk shift in favor of the shareholders who can diversify and against employees who really can't, and who, because firms are now not diversified in response to the shareholder objectives, are going to be imposing greater risk of business failure on the employees. And I think that's a very deep issue that goes to the kind of systematic risk that these funds need to contend with, and society as well. The final point I want to make is really about the common ownership critique. So putting aside the empirics, which maybe are debatable, the concern is that these funds acting in some way collectively are exerting power in a way that the antitrust laws ought to take account of. A couple points. First, the way that I'm proposing that these firms express their systematic concerns is essentially reactive. It's responsive. There are many ESG-focused intermediaries in the market with various proposals by which firms may reduce systematic risk. The point is, the funds will be in a position to evaluate them. This is similar to a model that Ron and I have about how hedge funds work. But basically, there's plenty of intermediaries, ESG intermediaries, setting up proposals for the large funds to evaluate. And it is right that that's the way it goes, because this argument that these funds should engage in greater firm-specific stewardship is going to give up the main defense that they have to antitrust, which is to say we have no channel through which this collusive activity could occur. The more firm-specific engagement that State Street does, the greater their exposure to antitrust concerns, I think. But the second point is that the welfare effects here of engagement on systematic concerns are not the concerns that the antitrust laws should care about, because the goal is not to engage in monopolization or to extract from consumers for the benefit of the shareholders. Rather, it's to reduce risk, not only through the portfolio, but throughout the economy as a whole. And so, in effect, given that everybody participates in the economy as a whole, the activity here to reduce systematic risk and thereby avoid the negative impact will be an increase in the welfare of everyone, whether or not they are the shareholders in these firms. So I think I'll stop. Ron, you're muted.
Clear. The first commentator is Roy Cameron, head of investment stewardship in the Americas at BlackRock, and sort of running the show that Jeff is talking about changing.
Well, hello everyone, and thank you for this opportunity to speak on behalf of BlackRock. I thought that it would be helpful to kind of level set in terms of kind of how we see the world through BlackRock's eyes, and also to just kind of give a sense of kind of how we think about the world. First of all, when we think about the work that the team does, the investment stewardship team does, it is viewed as an investment function. The team bridges various portfolio management groups and aims to deliver meaningful value to our clients through a range of activities. We've talked about the evolution of governance a little bit, or earlier today there were conversations around that. Engagement and relationship management with portfolio companies, proxy voting, market updates, and engaging in the public policy debate. When we think about the work that we do it through this lens of long-term value creation, and it was something that was just referred to, and that is this focus on the fact that the stewardship work that we do, it is for the index side of the organization. When you think about the assets that BlackRock has under management, the equity assets are about half of the total assets under management. And the equity assets, they represent about $3.5 trillion. Of that, more than 90% of it is oriented in index strategies. And so the work that we do is really focused on that. So we are long-term investors. Typically, the clients that we're representing, the funds are related to retirement or college savings. And so it's really long-term in nature, sometimes in decades. And so we use our voice to advocate for practices and governance practices that encourage long-term sustainability. And we do that by engaging with companies to talk about risk mitigation and risk management strategies. And we'll talk about that in just a little bit more detail. Just to give you a sense of kind of scale in terms of the work that we do, we voted on over 16,000 shareholder meetings and on approximately 150,000 proposals in the last voting season. And we held over 3,000 engagements on a global basis. And we also presented at over 150 conferences and public events on a global basis. There are different strategies in terms of how to attack the investment stewardship business. We have a very dedicated team on a global basis. We operate out of 7 offices. We have over 45 members on our team on a global basis. We are in 85 voting markets. We have the largest dedicated stewardship team in the industry. And I think it's interesting to really focus on the composition of those teams, particularly on a regional basis. The composition is about a third in terms of geographical footprint. And in the US and EMEA in particular, we have sector-focused specialists who are not only responsible for engaging with the companies, they're also responsible for voting. In addition to that, we do have active portfolio managers, which represent a smaller portion of the assets under management. But that expertise is very important to us, and we leverage that. in terms of having joint meetings with companies and really try to understand holistically where companies are in terms of their corporate life, and again, how they are mitigating risk. So two principal things that we focus on again are engaging with companies and also using our vote. And on the voting, on the engagement side, I just wanted to highlight the engagement priorities, because sometimes, you know, there is a question as when you think about engagement, what exactly are you talking to companies about? And there are 5 engagement priorities for us. These are refreshed every year, but typically the core of them remains the same. Probably won't be a surprise that board quality is very important to us. Environmental risk and opportunities, corporate strategy and capital allocation, compensation that promotes long-termism, and human capital management. Now, so I would highlight that you can certainly pull those priorities up into this very, very common, you know, ESG framework. We spend a lot of time focusing on board quality, because evidence has shown that if you have the right people in the seat at the board level, they tend to exercise their responsibilities in terms of overseeing management. And in addition to that, they tend to make better decisions, which the board in and of itself at its core is a decision-making body. So wanted to highlight that, and also wanted to do a little bit of a breakdown just in terms of votes in this last voting season. So there was some conversation just in terms of holding directors accountable, and I just wanted to put a spotlight on that. That is certainly one of the focuses of ours. And we voted against over 5,000 directors at over close to 2,800 companies, driven by concerns regarding director independence, insufficient progress on board diversity, and overcommitted directors as well. Just to put some numbers around that, just for clarity, lack of director independence, we voted against over 1,700 directors. For insufficient diversity, we voted against over 1,600 directors. And for overboarding, we voted against 728 directors. And in terms of engagements, I just wanted to drill down in that a little bit as well. The engagements themselves, just to give a bit of a breakdown, over 3,000 engagements, and in environmental in particular. And you may recall that at the beginning of the year, Larry talked about climate risk being investment risk. So we certainly upped the number of engagements that focused on environmental and risk, as well as opportunities. So in that space, we had over 1,200 engagements, which was a 300% increase on a year-over-year basis. In the social category, which is obviously critically important, particularly around human capital management and supply chain management, et cetera, the increase was 173%, coming in 965 engagements. And in the G category, governance, which continues to be the linchpin, over 2,800 engagements there, representing a 40% or close to a 50% increase. So I thought that level setting would be helpful in terms of the conversations that we have going forward.
Right. Thank you.
Sure.
I think we'll save the questions for the end, because I think what's going to be interesting is the questions are going to cross-cut everybody who's on the panel. The next commentator is Patrick Bolton, who's a professor of economics at the Columbia Business School, and just to tie his work into the subject matter of the panel, he has also written a wonderful piece which generates a portfolio management technique that has the promise of reducing the carbon footprint on the order of about 40% without costing on the performance against the benchmark. So Patrick's got his hand in both worlds. Patrick.
Thank you, Ron. I have prepared a few slides, so let me share my screen. In the interest of time, jump right in to my presentation. Like Jeff in his presentation, I have two screens in front of me, so I hope I won't be too confused by this. First of all, I would like to thank the organizers for putting me on this panel. I really enjoyed reading the piece by Jeff Gordon on systematic stewardship. My comments will if you want, will to a large extent be in line with the main argument that Professor Rorden is making in his article.
Sorry,
So what I will do is start with the counter argument, the critique of his argument, and then I will offer a counter argument, which will take a broader perspective than he's taking. And then in the end, I want to return to the dilemma that he raised in his final remarks.
Sorry, Patrick, just to interrupt you there. You're not sharing your screen. I don't know if you're planning to.
Oh, I'm not sharing the screen. Thank you for letting me know. I thought I had, but is that better now?
I can see it now. If you want to put it in slideshow.
You can see it now. Great. Okay. So.
Perfect.
Yeah, so you didn't miss much. I gave you the outline. And so now let me dig into my comments. So the counter argument. So this is a bit of a dry academic point here, but it's important to get this out of the way. You know, the neoclassical perspective, which we've lived with until very recently in corporate governance, it says, you know, when it comes to systematic risk, well, you know, to use a term that's now become popular, it is what it is. You take it and you accept it. And if there's something to be done by financial markets is to price the systematic risk correctly. It's a pricing problem, not a governance problem. Okay, that's the first point. Now, there may be externalities. You know, climate change and carbon emissions are the prime example. But here the neoclassical perspective says, well, you know, externalities, business can deal with it. And we have a very fundamental idea in law and economics, the Coase theorem, which says that, you know, all you need to do is allocate property rights. And once property rights are properly allocated, externalities will be internalized through bargaining. This idea, of course, has reached its limits, especially when it comes to climate change. Doesn't work in this particular example. And so then what do we do when the Coase theorem doesn't work? Well, here's the other part of the neoclassical analysis. It says, well, we have a division of labor. Externalities are a matter of public policy, and the private sector is dealing with making money. Okay, I was at a recent, not so recent actually, a few years ago, there was a corporate governance event at Columbia, and Steve Ratner was on the panel, and he made exactly that argument. He said, private sector should worry about making money. Any other aspects are a matter of public policy. And, you know, public policy is about setting the rules, enforcing them, and then private sector is about playing, competing under those rules. And if there's a problem left for corporate governance, it's one about solving a principal agent problem between the executives of the company and the shareholders who are trying to make sure that executives maximize shareholder value. Okay, that's the counter argument. What about the counter argument? The counter argument, and here I'm taking a broader perspective than what's taken in the article. The counter argument is that politics is broken. The division of labor doesn't work. Public sector is not dealing with externalities. And if you're faced with a situation where the public sector isn't doing its job, what do you do? What do you do when public policy fails to address the systematic risk? That's the problem. And I think we all understand when it comes to climate change, business as usual is not an option. And I can't think of a better way of making that point as an old cartoon from the New Yorker. Some of you may have seen it. I think it makes this point succinctly and beautifully. And here it is. Yes, the planet got destroyed, but for a beautiful moment in time, we created a lot of value for shareholders. I think that's the problem we're in today. And in preparing my remarks, I couldn't think of anything better to do than going back to Al Gore's book, An Inconvenient Truth, and to state, the nature of the problem we're dealing with. Here's what he says in the middle of the book. We are witnessing an unprecedented and massive collision between our civilization and the Earth. So that's really the magnitude of the challenge. And I couldn't resist taking out two quotes of Mark Twain that he has in the book. One is, of course, very pertinent to what we're discussing. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. That's a problem we've been facing very widely, both in the political sphere and in the governance sphere. And the second quote is purely gratuitous, but it was too good not to put on the slide. Denial ain't just a river in Egypt. So that's the point. And another way of putting the general argument is one that I heard David Pitt Watson make he's the former head of UNEP-FI. This was at a conference in preparation for the Paris Accord. And he said, when it comes to climate change, we're all players. We're not spectators. And that's really the point. So we're all players here, and asset managers are players, corporations are players, banks are players, other investors are players, central banks are players, asset owners are players. And this is, echoing remarks that Ray Cameron made just earlier. Asset owners are a big part of what's driving the change here. They are coming with mandates. They want climate change to be taken seriously, and they are pushing asset managers to move in that direction. So the general point is that the question is not whether asset managers must engage to combat climate change, but how they can engage most effectively. That's what we really need to discuss going forward. There are plenty of things to touch on here, but I won't have time to do that. But let me close by touching on the final point that marks. That's the balance that the asset manager will face. And the point is that to be effective, engagement requires coordinated action among asset managers and between institutional investors and regulators. And that creates a risk of running afoul of antitrust laws. So I would urge Professor Gordon to really develop that point more and say to what extent we can avoid facing that dilemma, and where the limits are in engagement, asset management world engagement, and how this, where do we collide with the antitrust world. So that will be all for me, and let me stop sharing my screen.
Thank you, Patrick. The next speaker is William McNabb, retired from Vanguard in 2018 after holding basically the highest positions in the organization, and he's a Milstein Center advisory board member. So he's seeing it both from as inside as you could imagine, and now from the outside.
Thank you, and thanks for having me. And Jeff, I just want to commend you on your paper. It's really thoughtful. It's one of the more innovative and sort of fresh ways of thinking about the problem. I will confess I haven't shown it to the Vanguard team since I just got it, and I'm dying to hear what my former colleagues at Vanguard think about it. And I'm really anxious to see you finish fleshing it out and get to the conclusions. But at a high level, I think it at least provides some real thought-provoking content for us to go through. To frame my perspectives on Jeff's paper, I think just a little bit of context is helpful. You know, as you just heard, I'm retired from Vanguard, so my views are going to be my views, not Vanguard's views, but they're certainly going to be influenced by my 32 years there, where we had both index and active equity strategies. And in particular, it's going to be influenced by a couple of things about, you know, being part of Vanguard. Really, you know, reinforces with you as an investor or as a leader. And first and foremost, and this came up in the first panel quite a bit, but we never, ever, ever, ever forget when we're thinking about governance that this is not our money. And I think that's been lost in a lot of the literature. Now, Lucian actually went pretty deep on it, and I'll have a couple of comments on that later. But you know, the idea that it's not our money certainly influenced all of our thinking in terms of how to respond to governance challenges and so forth. And again, unlike many of the other firms that you're going to hear from, our mix is almost all retail. I think of Vanguard's asset base, 98% is in the hands of an individual investor, either directly, you know, just Vanguard.com, through a financial advisor, or as part of a 401k plan. The other 2% would be DB plans, endowments, and foundations, where we're kind of an outsourced CIO for them, but it's a relatively small fraction. And I do think how you think about this really differs if it's your money versus you're really speaking on behalf of beneficial investors. The other contextual thing just to put out there is just like a 2-minute version of history. You know, if you go back to the 1960s, when 90% of the equity markets in the US were owned directly by retail investors and only about 10% by professional investors, there was no such thing as governance. No one talked about it. No one thought about it. It never came up in any dialogues. Boards were essentially, you know, friends and family of management teams, et cetera, you know, with the exception of just a handful of, you know, the largest, best run companies. But for the most part, that's what you saw. You know, as the democratization of the markets through funds in particular took place in the 80s, 90s, and early 2000s, obviously you saw a shift from direct retail ownership to indirect ownership through funds. And that really began to obviously change the landscape. But even as little as 15 years ago, 2005, no one was really talking about governance in the asset management world except a few academics and a handful of activists. We at Vanguard at that point in time had seen some really nasty proxy fights. And what was at the heart of the issue in those proxy fights was really what's the right time frame to make judgments, and it really was a short-term versus long-termism, if you will, question. And not saying that one particular side or the other of the argument was correct, but one of our conclusions at that point in time was longer-term views were getting shorter shrift. And the evidence for that was, you know, the nature of some of the proxy fights, but it was also in the data, there was an inexorable march in terms of active equity fund managers towards shorter and shorter holding periods. And you can see this in the portfolio turnover data, and it's really, really clear. I bring that up because that short-term versus long-term was actually one of the catalysts for us stepping back as a firm and trying to rethink what governance might look like. And it really was, you know, the acknowledgement that, especially in our index funds, we are forever shareholders. You know, you own the stock as long as it's in the index. And we wanted boards of directors to know that we were much more interested in short-term or in long-term value creation, and much less interested, frankly, not at all interested in short-term, you know, the short-term ups and downs of this particular company's stock or the marketplace in general. So again, I give you that just as context because it does inform, how I'm going to sort of respond to Jeff's paper. So, in no particular order, just a few observations. So, one, Jeff, I'm going to commend you. It's a well done paper, and the history that you lay out is actually, I think, very, very, very useful, and has actually been missing from some of the dialogue. The fundamental application of modern portfolio theory is new and innovative, and I think it's actually a very useful lens. I need to think through the implications a little bit more. It's interesting, again, if I put on my retail shareholder hat in particular, risk-adjusted returns in individual products is never really part of the conversation. We really think about, or they think about, risk-adjusted returns much more as in asset class diversification, if you will, as the source of, or asset class, mixture being the source of diversification. And it's risk-adjusted returns are really much more at the portfolio level in terms of the focus, as opposed to the individual product. That doesn't make the argument any less salient, but I do want to think through those, just those implications. As I was reading the paper, one of the fundamental question I stepped back and asked myself is, what problems are we trying to solve in all of these discussions? And as I already alluded to, for us originally, short-term versus long-term thinking was certainly topic number one. I would say topic number two for us was misalignment of incentives, some of which has to do with timeframes, but it also had to do with success and performance. And then more recently, I would say topic number three in terms of a problem is board composition. And here, I would say, and I'll come back to this in a minute, board composition more as a risk mitigant as opposed to a return enhancer, although there is a mix, again, to be fair. So when as I read through the paper, before I get to that, as I think about what were the problems we were trying to solve through governance, if I had to sort of come up with a phrase, I would say we're trying to make the system better, right? We're trying to improve the overall system. And I think Professor Gordon would argue that's a mixture of risk reduction, but also in return enhancement. So, there's a mixture going on. And of course, this paper focuses much more on the risk reduction elements. The good news, I think, in terms of sort of practical implications of the paper are, I think there's actually a movement in this direction happening naturally. And I think what the paper may end up doing for us is giving us a little bit sharper focus and, make us ask some tougher questions of ourselves as we continue to, march forward on this governance journey. And the evidence I would ascribe to that would be 3 or 4 points. So one, when you look at the evolution of governance principles from the very beginning, when the so-called Buffett-Diamond corporate principles were issued, and what ISG put forth and so forth, I think as you've watched those progress, you've actually seen much more of a mix between what you might term return enhancers with risk reducers. And so there's more balance there. Second, when I look at all the big asset managers, whether it's index or active, there is a renewed focus on board composition. And Richard from State Street brought this up. I actually think it's one of the things that this dialogue we could go a lot deeper on. Maybe it's another seminar, but to me, it's actually at the heart of everything. And getting better board governance is really what this is all about. The shareholders elect directors, but directors are really standing in and are that interface between management and the ultimate owners of the company, and their role is incredibly critical here. And there's a lot of work going on in terms of board composition. And I would argue much of this is much more around reducing risk. Jeff and I had a chance to talk about this a little bit beforehand. And, if you looked at some of the diversity elements of board composition, I would actually put those more in the return enhancement category, because what you're seeing there is just a broader pool, and hopefully a broader pool leads to better quality. But on the risk reduction side, we're seeing a real pivot in terms of the emphasis of the shareholders around what kinds of skills and experiences do different directors bring. And you're seeing much more discussion around domain expertise and how to bring that to bear in terms of oversight, as well as a real mix of technical skills. So again, we can come back to that in the Q&A if people are interested in, but I do think it's evidence that, again, there's this sort of movement toward, I will call it a systematic approach. Jeff, in his paper, uses ESG and in particular climate disclosure as an example of what might be a candidate for systematic risk reduction. I would say at least the activities that I've seen both inside boardrooms where I sit, as well as investors on the outside, it's all about disclosure and, in a sense, trying to give the marketplace much broader risk disclosure so that the risks can be more properly assessed. And again, that feels to me already to be headed in a much more systematic way. And again, we can talk about how to take it to the next step. And then finally, there is work being done right now by a number of groups to really promote long-termism, whether it's FCLT, focused capital on the long term, or CECP's work, where companies are really being encouraged to share long-term thinking, long-term plans, long-term market dynamics and so forth with investors, as opposed to just the typical quarterly readouts. And I think that is a really good trend. And again, may actually be evidence that some of what Jeff was talking about in his paper is beginning to happen. And then the last thing I wanted to say, and then we can move on, is I can't let the first panel go without at least a couple of points of comment. One, Dr. Lund's ideas around how to solve this, I would just say respectfully, that is an activist hedge fund's dream fantasy. I mean, that to me would be a fantastic outcome if you're an activist hedge fund, to eliminate, in a sense, a longer term view. And the example she used about the 7% decline in the price the next day, that to me is exactly what the issue is. There was a very short term hit to the stock price. But then if you look at the long-term value that was created by I call it a more nuanced approach, you end up with, maybe a different argument. And quite a few active managers actually voted with management on that. It was not just an index thing. So that's point one. And then point two, as I already alluded to, some of the agency stuff, I think we should be very careful about assuming we know what, I say we, the academic world knows what beneficial investors actually, what they actually want. I can tell you in my travels and seeing data from 25 million individual investors at Vanguard, governance broadly just doesn't come up. So they're very, very concerned that their funds are being run with a view toward creating the kind of wealth that they're trying to create by being investors. I do think this is where this systematic approach that Jeff talks about, though, has some real appeal, because I also think implicitly many of those beneficial investors would like to see the system continue to improve, so that, again, make no mistake, good governance isn't going to eliminate all failures, all corporate failures. But the hope, I think, is that good governance will reduce, if you will, the severity of some of those tails. Thanks.
Thank you. We're going to, let me just throw one thing out, which people will pick up going forward if they think it's right. We've talked a lot about firm governance. As I listen to what we want funds to do, the first question that comes to my mind is, how do we pay the people in the governance group? How do we pay portfolio managers? What are they actually getting paid to accomplish? And we'll have a view on, we'll have a better sense of that if we know what that is. And I'm not sure there's very good disclosure about how active active mutual fund managers or non-transparent ETF managers are paid, how the governance group is paid. But that would be if we thought of it as a company, it would be the kind of disclosure that we might want. Okay, that may interest people or not, but we want to move to someone who will interest people. Jill Fish is a chaired professor at the University of Pennsylvania Law School and the co-director of the Institute of Law and Economics, and has written a great deal recently about precisely these kinds of issues. Jill?
So can you hear me?
Can hear you.
And can you see the slides?
You've just started screen sharing. It hasn't.
It says it's paused. I wasn't the one that paused it. Can whoever is controlling it unpause it?
Elaine, let's see.
No, it's not. I haven't got it on pause. Do you want to try it again? Do you want to restart?
Okay.
Well, there you are.
Yep. Okay.
Okay.
Great. Okay, so it's working. Thank you. So again, let me echo everybody's thanks for being here. It's a terrific topic. It's a really impressive group of speakers. I am grateful to be included among them. So I just put up a definition of stewardship, since this is a conference about stewardship. Obviously, we have a huge amount of attention worldwide on institutional investor stewardship. We heard from the earlier panel, and Jeff's paper dovetails very nicely with the earlier panel. Lucian and Scott arguing that institutional investors underinvest in stewardship. I'm still not entirely sure I know what underinvest means. Lucian said at the very end, well, so long as there's a staggered board out there, we know that institutional investors aren't doing enough. I guess I'm not entirely convinced by that definition, but to the extent you think that's a problem, obviously outside the United States, institutional investor stewardship is increasingly a mandate. It's an obligation. And we'll hear later from Dionysia and Dan. They've put together this book that just describes the explosion of stewardship codes and stewardship obligations around the world. So Jeff's paper fits in really well with all of that, right? So stewardship obviously presents challenges, right? As Jeff says very clearly in the paper, look, large diversified investors aren't really a good source of firm-specific operational improvements. Index funds in particular seek to minimize costs, which means it's hard for them to justify significant investments, both in evaluating firms on a firm-specific basis and in engagement. How much money do we really want them to spend, especially since, as a number of commentators have explained, index funds compete primarily on price. Institutional investors, and we heard just a little bit of this from Bill, may face their own agency problems, right? What the portfolio manager or the fund governance committee thinks is socially optimal might not be either what the beneficial owners think is socially optimal or what they want their managers to do with the investors' money. And Jeff alludes to this in his paper, and it hasn't really come out in the discussion. Stewardship may involve, or at least may raise, the question of whether portfolio companies should make decisions that sacrifice economic value in favor of other objectives, like reducing climate change. Right. And so I talk about a lot of this in my chapter in Dan and Dionysia's book, which is in the materials. And, there are a lot of potential problems. So if stewardship is about voting and engaging, but we don't really trust investors to do it adequately, some people like Dorothy Lund say, well, we conclude, index funds at least shouldn't vote. Right? I've got a problem with that. I've got a problem for that because, number one, we lose, right? Then we can sort of wrap up this conference because we lose the potential for stewardship. We leave voting to investors who have potentially more problematic incentives, right? So the debate that Bill referred to between short-term and long-term investors, active managers tend to have a shorter time frame, right? That's a result of more trading by the portfolio managers themselves. more trading by the beneficial owners, and their compensation structure. In addition, voting today, shareholder voting, has exploded into a wide range of issues, right? It's not just shareholder proposals, it's say on pay, it's approval of conflict of interest transactions in a way that often insulates those transactions from judicial oversight. And if you say a big chunk of our investors aren't going to vote, you delegitimize that oversight role of the voting process. So I think that's problematic. Right? So Jeff's project is an attempt to respond to these problems, right? So his motivating question is, can you defend investor stewardship in terms of economic value, right? And he focuses in particular on index funds. His answer is yes, right? And he comes up with this theory of systematic stewardship that's really, I think, transformative, both because he places it within what index funds reasonably can be expected to do, and it's defensible in terms of maximizing fund economic value, right? And the underlying theory is systemic stewardship is about risk mitigation, risks that affect a broad range of the companies within the index funds portfolio, right? And this, therefore, is a defense of index fund engagement that responds to our earlier panel, that responds to some of my earlier critiques, and that also provides a rationale for index funds to focus on certain systematic risks, right? In climate change, we heard from Patrick about climate change. Obviously, that's one of them, right? So let me just break this down into two insights or two sets of insights, right? So number one, index funds can do this, right? Systemic stewardship is within the competence of your index fund, right? Reducing portfolio risk doesn't require that you do a deep dive into individual firms, right? ESG governance initiatives can be defended in terms of their effect on the average firm, right? So Vanguard has a policy of voting against staggered boards. And I asked Glenn Burham once, there's all these mixed empirical studies, there's suggestions that in some cases staggered boards are actually helpful to firms. And he said, well, yes, but on average, on the whole, we think staggered boards reduce firm value. So when Vanguard has this policy, it's not making a firm-specific evaluation that in every case this staggered board is bad. It's saying on average, this is a way of improving, this is a way of reducing systematic risk, right? What Jeff is describing is not just a theory, it's how index funds currently behave and why it makes sense for them to behave that way, right? So, index funds support, if you look at index fund voting behavior, the initiatives in which we see index funds voting are this kind of, initiatives to support board accountability to shareholders, one share, one vote, annual elections, majority voting, monitoring boards, just what Bill was talking about, and greater environmental disclosures. All of them fit within his model, right? So that's insight number one. Insight number two, right? Not only is this within fund competence, but it makes sense economically. Risk mitigation, it's consistent with index fund incentives, right? A diversified investor seeks to maximize risk-adjusted return. Systematic risk reduces risk-adjusted returns across the investor's overall portfolio, right? This is the economic theory of the paper. And this is an early stage draft, so Jeff hasn't spelled all of this out. I guess I have a couple of questions for him going forward. And one set of questions, I'm not an economist, but I thought that investors were compensated for bearing risk that couldn't be diversified away. To the extent that this is a way of reducing risk, are investors going to continue to achieve the same returns, right? And another way of thinking about this is if you look at the risk-return trade-off, are we simply moving the risk-return mixture along the efficient frontier, or are we doing something that moves the frontier itself? I don't know the answer. I don't think Jeff, at least in the current draft, has fully had the opportunities to spell out his thinking on that, but I'd like to hear more, right? And in particular, right, there's at least the potential that by reducing overall market risk, funds are going to kind of shoot themselves in the foot because we're going to see market returns decrease, right? This is kind of, an extreme case. It's like moving from an equity portfolio to government bonds. Yes, there's less risk, but there's a lot less return. So it's just a question I have about the theory. So an additional concern, and I've raised this on a number of occasions, is, stewardship sounds great. And Patrick gave us a good defense of stewardship against climate change, right? Bill talked about stewardship to increase board accountability. There's all sorts of issues out there. And what I worry about from an investor perspective is, how does somebody like BlackRock or Vanguard choose which should be the funds and the portfolio firms' priorities, right? Because, you can't be everything to all people. So, how do we balance these things? Where should institutional investors concentrate their time? What I love about the paper is the paper gives us a way of at least grappling with that question, right? The paper says, look, index funds should deal with risks that have broad economic effects, like climate change, like financial stability risk, like social stability risk, right? Those are the things that matter. Those are, for now, the first priorities, right? And in particular, the paper says, you don't have to confront critical trade-offs among these different priorities. And one reason you don't have to do that is there are market forces to bear. Market forces can deal with these trade-offs through capital market discipline, through pricing, so long as markets are efficient, so long as markets are informed, right? So he says, look, it's low-hanging fruit. It's a cheap, easy thing that index funds can do. They can encourage greater disclosure about these key issues, right? And the market can then respond and sort of kick the tires and see if the firm policy is right. So my only concern about that is I worry about economically significant risk disclosures being the subject of firm-specific private ordering, right? If these things really matter, if they're not incorporated in market price, and they should be, what about mandatory disclosure, right? We had private ordering for disclosure in the capital markets for many years. It didn't work very well. Merritt, you've written papers on this topic, right? And the government comes in and says, gee, there has to be mandatory disclosure across the board because the firms that are doing good things are disclosing pretty well, and the lemons are kind of hiding what they're doing. Why isn't that same analysis applicable to systemic risk disclosures? And if it is, shouldn't we focus more on regulation rather than stewardship? So again, this is a draft, right? These are challenges. I'm confident that Jeff can meet these challenges, but it's a terrific topic. It's a terrific concept of responding to and cabining some of the concerns that I think we all have about institutional investors. And I commend Jeff on this project. Thank you.
Thank you, Jill. Last speaker, and then both questions and interaction among the panel. Teresa Whitmash, the Executive Director of the Washington State Investment Board. As I did my little bit of research on the order of about $150 billion under assets across a pretty wide portfolio range, and a member of the board, the advisory board of the Milstein Center. And thank you for doing that.
Well, thank you.
Teresa?
It's tough. It's tough to be the final runner in a long relay race. I'm feeling pressure to run fast and get my comments quickly. But I do want to thank Jeff, first of all, for the opportunity to comment on your paper, and particularly the focus that I was asked to bring to the conversation is examining your concept for fit with current practices of institutional investors. So that hopefully that'll be additive to the conversation. I have both positive observations. I think your concepts are terrific and will add to the evolving practices of ESG risk management and assessment. But I also have some remarks I hope you'll consider as constructive as you continue to flesh out your thoughts. To start, I think your paper does really, in a good way, emphasize the legitimacy and importance of systematic risk as a vital keystone to asset stewardship, and particularly with passive managers. And just for the audience sake, we made our decision years ago on equities to be primarily passive. So we're passive in all developed markets. The only place we're active in equities is in emerging markets. And even there, our default is passive unless we can find high conviction managers. So we think with our broad-based index funds, we know that when it comes to systematic risk, we have no choice but to essentially go with the flow of the markets. So I think, Jeff, you provided an interesting framework about how to factor those systematic risks into our investment decision processes. And I think your concepts are timely. We as institutional investors are increasingly asked to factor in externalities into our investment decision process, such as climate risk, social instability, financial stability. And historically, our passive style of investing and our risk models have been unable to adequately address these non-financial risks. I think you also rightly attempt to eliminate the fiduciary conundrum that many of us find over traditional risk-return trade-offs. You do this by placing an importance on the potential material impact systematic risk has on returns, and particularly for those of us who are long horizon investors. So in theory, I really like many of the concepts you present in your paper, but as a practitioner, I think it has some real challenges, and that's going to be primarily what I focus on. So the first challenge, and this will be something that academics can completely relate to, is the absence of data measurement and risk methodologies. The degree of available data and the lack of maturation of measurement and risk assessment on such broad-based ESG issues is really mismatched against the degree of measurement utilized in traditional portfolio management. So if we ever want portfolio managers to pay attention to these things, the measurement tools and the methodologies have to evolve. And climate change certainly represents systematic risk for all of our portfolios, but we also have to admit that we face real challenges in being able to clearly apply the risk reduction framework that is aspirational, not only in the paper, but in society. The disclosures and measurements of data are just not yet advanced enough to fit the full needs of my portfolio managers. And let me give a particular example. Every couple of years, we do update our capital market assumptions, and essentially our CMAs are an important building block into our asset allocation studies. And so essentially our CMAs are our outlook for a particular asset class, the return expectations going forward over a 15-year time period. So our board was very interested in having our risk team figure out if they could build climate risk into the CMAs. In other words, would there be a haircut from climate risk, from systematic climate risk exposure that could get captured and reflected in our CMAs? And bottom line, after working on this for basically a full year with a lot of really smart people working on it, the carefully considered answer from our team was that they could not quantify the systematic risk sufficiently to create any kind of measured certainty. And there's a couple things that were problematic. They could not measure how much our climate risk expectations are already embedded in existing return assumptions. They could not tell how much policy adaptations or industry transition will occur during that 15-year time horizon in response to climate risk and how that could influence return assumptions. And they also could not find models or pathway scenarios that don't suffer from large deviation or gaps in unknown information. So ultimately, the team concluded that CMAs were not the best place to express our concerns about climate risk. In other words, at a systematic level, at least at that point, given that tool, we could not do it. So I think ironically, given Dr. Gordon's suggestion that passive investors focus on systematic risk rather than idiosyncratic, without reliable systematic risk measures, we're left really with idiosyncratic risk reduction strategies as our most viable course of action. For instance, we can intervene through engagement at the portfolio company level through traditional governance practices, which have been talked about already today, such as shareholder proposals related to climate risk disclosure, voting out directors who refuse to be risk aware, engaging our collective voices as institutional investors in broader actions, such as asking policymakers for better disclosure standards. So while we agree climate risk is systemic or systematic, it serves as an example of why with so many non-traditional risks, we can't always just focus on what are the other systematic or idiosyncratic. I also wanted to make a comment on idiosyncratic risk. I think in the global economy, it's increasingly likely that idiosyncratic risk will result in systematic risk over time. And I think it's clear with Dr. Gordon's CFI example that some company-specific risks do transcend into systematic impacts, or at least create catalysts for broad market-wide impacts. And I think if you look at our current stock market and the concentration, the large market cap concentrated in fewer companies, that even gives rise to more concerns about a single company's actions transmitting to the whole market. And I also think it has to do with our digital age. Information moves impulsively, and as we are learning, can be trafficked or manipulated without regard to factual integrity. And that in this context, I'm not sure we can be confident that drawing a line between idiosyncratic and systematic risk will be clear, permanent, or even actionable. So that leads me to kind of my next observation. If we have no choice but to pay attention to idiosyncratic risk, then we also have to engage at that level. And I think the stewardship choices presented by Dr. Gordon in the paper are presented, and I don't think he literally believes this, but they are presented as a binary fork in the road. Choices between firm-specific engagement versus portfolio-level actions, corporate governance versus strategic or operational issues, initiatory and proactive actions versus responsive or reactive, acting unilaterally as a sole investor or joining forces with others. But I think in reality, when faced with this sort of multiple choice test of engagements, asset owners must choose all of the above. We often need to deploy all of these strategies. And I think we as investors would resist a framework that would limit that broad array of engagement options that might allow us to address idiosyncratic and systematic risks simultaneously. I think the underlying causes of risk are so complex, and identifying and mitigating those risks requires an entire toolkit of mitigations that we believe work in concert. And again, let's go back to the CFI example. It took multiple players to build risk mitigation into the system post-financial crisis. Policymakers had a role in passing laws limiting leverage, for instance. Regulators worldwide developed stress tests to assess SIFI balance sheet risk. Boards beefed up their risk enterprise and oversight. And investors played an important collective role in each of those parties' actions. Similarly, investors are active individually and collectively on many of the ESG issues and will continue to attempt to influence policy and corporate practice where we see risk to returns. And kind of a final point in terms of where I think I'd like to see Jeff pursue a little more is while we continue to engage in broad risk reduction strategies related to ESG issues, we are not unbounded when it comes to return trade-offs. Dr. Gordon introduces the concept of trading off investment returns in exchange for what I would call theoretical reduction of systematic risk. I say it's theoretical because of the problem of data and meaningful measures. It's hard to know what we're trading off with any kind of precision. And if investors enter into such a bargain without sound risk analysis, let's say we compromise return in exchange for addressing a particular ESG issue, we may enter what we often refer to in our business as a slippery slope and get pulled into a lot of distracting policy debates. No matter how important or good the cause, we as public plan fiduciaries are not in the business of beneficial causes. We are in the business of prudent return optimization, and our currency is measurable risk and return. And as I've just described, measurements are still very imprecise on many ESG issues. I don't think we're free to lean into a cause unless we can demonstrate a sound fiduciary tie. And I think this is a good thing. This binds us to our beneficiaries. It serves as a strong defense against political agendas and other agents who want to access our beneficiaries' funds in order to advance many of their well-intended societal purposes. So I would not suggest that a performance trade-off can be identified and implemented without being grounded in a sophisticated level of risk analysis. It's our view that this level of risk analysis is just not yet available. So a performance trade-off cannot always be accommodated without a potential breach of fiduciary duty. So does that mean we ignore ESG until the measures catch up? Absolutely not. We're committed to pushing for better disclosure. We're committed to the development of non-traditional data and analysis. This is a place where I think big data really comes in. I think there's a lot of non-traditional data out there that can help us take a look at systematic risk. So we are committed to many of the concepts that Jeff has put in his paper, but again, like everything, implementation always has its challenges. What I do agree with fully in the paper, Jeff has identified 4 or 5 really strong asset stewardship principles that we can completely get behind. One is better disclosure equals better stewardship. And companies are moving toward greater and more reasonable disclosure of information. And this can only help all players in the value chain. Better measurement equals informed investment and engagement. So measurement, as measurement methods advance, this inevitably will help us apply ESG factors in a prudent way. Strong governance equals strong E&S, and that's already been talked about by several of the speakers. Governance is kind of a super spreader factor in ESG. By continuing to engage and invest in sound governance practices, we can expect collateral policy impacts and influences on wide variety of ESG issues. And finally, as we get better at assessing these risks, better insights will lead to better decisions. And I think we'll better be able to see where the systematic risk lives and be in a better position to address it. And then finally, this has already been addressed by several speakers, this long-term view and long-term discipline is a common denominator across all of these issues. As we'll see a convergence of investment goals and ESG goals when we look at the long horizon, because eventually externalities do get priced in either proactively or after the fact, as in the case of a company blow up. So with that, I'll conclude my remarks and thank you, Dr. Gordon, for stimulating so much thinking on our end of the State Investment Board.
Right, so thank you. Jeff, let's take a couple of minutes away from lunch and give you a chance to respond or thoughts about the last session. Jeff, I think you need to be unmuted.
Yeah, good. The discussion was terrific, and I really am really glad for all of the reactions. And of course, this is a first draft, so there's a ways to go. Let me just respond to 3 themes that I think were found in many of the comments. One of which, Patrick's point about government, not governance at the firm level, but government. So, you know, it is a deep point that the need for asset managers to think about systematic issues reflects government's failure to do so. because you're right. I mean, ideally, government would have set up some system that's going to mitigate these various systemic risks precisely because they are systemic. And it would be good governance to mitigate them. But the point is, that's not occurring. And in a way, it brings back to a theme I adverted to at the very beginning, which is the failure is not at only the national level, but at the global level, which is to say, this is a global issue. And ironically, the asset managers, precisely because their investments are international, global, in a way, what I said, it's kind of in half jest that, you know, we're the legislators coming up with a view by which the asset managers can take account of systematic risk or force, in some ways, its mitigation by various disclosure strategies and have the market put pressure on firms. You know, that is, you know, global governance by asset managers in a world in which national governance is flawed and global governance otherwise doesn't exist. So that's a point I want to reflect on more. Pricing point. So this was in a Q&A. Richard Berner made a point about their group in NYU working on this, and I want to follow up on that. And Teresa made the point, and I think, you know, in a way, how would this be applied? And her point is really right, which is to say, all right, you've got a theory by which one could defend a trade-off, but unless you can, in effect, price the trade-off, then how would an asset manager feel it's behaving in a fiduciarily consistent way? And so, therefore, that leads to a reason why the asset managers ought to be pushing for disclosure, both at the governmental level, the market level, and at the firm level, precisely because being able to price these things both can reduce the incidence of them, but also let them make the trade-off when they need to. Third point. So Teresa said that they're hesitant to do a firm-specific trade-off based on systematic risk and expected returns. One of the motivating examples for me was just how important it is to do that with respect to a SIFI, because we have the evidence that the failure of a systemically important financial firm can trigger global financial distress. And so therefore, it's not just a projection about the realization of a systematic risk. We have seen examples and how bad they are. And it seems to me that might provide, I mean, it's not just that we're looking for the portfolio idea, let's have disclosure rules, but rather when it comes to voting at the firm specific level, should we support an activist hedge fund who wants to have, you know, Goldman Sachs aggressively pursue more of its trading? It seems to me that the Washington State Investment Board is in a position to worry about, based on prior experience, what it would mean to license excess risk taking, given the fact that even that in this particular domain, the failure of a significant firm would have systematic effects. It's not just Exxon plus 20 other firms. It's a single firm, the failure of which would have the systematic effect. And you're right that the fine grain in thinking about what this means for firm-specific engagement needs to be better developed. Anyway, I'm very curious when Bill does take back comments or the ideas to some of the group at Vanguard, what their reaction is to it as well. And I'm
want to
going
speed
to
it up.
get everybody to give me their comments and slides because they're so valuable in my effort to move this thing forward.
Okay, then we're going to now take a lunch break. Be back at a little bit after 1 for our keynote speaker, Leo Strine, a remarkable man who has as many different positions at present as I have in my entire career. So we will get back then.
Thanks, everyone.
It picks up Teresa's and some of her comments that we talked
Okay, welcome back.
Did we just lose Eric?
It looks like that's the case, Rebecca. He's an elusive man.
It was a very short introduction. Jeff? Oh, sorry, you're on mute. Jeff, you're on mute? Oh, okay.
I'm now not on mute.
Perfect.
Sorry about that.
Oh, Eric's back.
Okay. Sorry. Excuse me. Sorry about that. I would like to welcome Leo Strine and Rebecca Henderson. Leo is going to start with a 40-minute address and then comments, and then we will take questions. So Leo, take it away.
Good to be with you. I'm a little nervous. I'm always nervous to be with big brains. I saw an R on the screen. I thought people were going to talk about R squared and things like that. That guys like me who were born in Baltimore and grew up in Hocassin, Delaware, don't know from, except for my fellow Hocassin man, Guhan Subramanian, who's a legend. But and I'm also a little nervous because speaking for 40 minutes on Zoom from a prepared text without my presidential teleprompter is very difficult. But I'm glad to be with you, and I want to applaud the Institute and Columbia for focusing on this. I think for too long, this has been a topic that society, but actually the academy, has really lagged on. The separation of ownership from ownership, as I've long called it, has been an important phenomena for decades now, and it has seismically changed the power balance within corporate governance. That's especially true in the United States, but it's also been a trend in the OECD and particularly in the EU, as the new Commission report of the EU points out. Today, I'm going to talk about what I think stewardship actually means if it's going to be a meaningful concept in the 21st century. And I'm going to address why any serious effort to rebalance our corporate governance system and address growing economic insecurity and inequality must include regulating the power of all classes of institutional investors. And they're basically three primary classes: pension funds, mutual funds, and hedge funds. And put simply, to do this, what you really need is regulation that makes institutional investors do what's required of any faithful fiduciary and any good citizens of a republic. They have to take seriously their obligations of fidelity by aligning their conduct with the real interests of those whose capital they hold. And they have to make money for themselves in a way that doesn't cause societal harm. Now, for many years, stewardship's been more of a name in the investment community for blaming the people who manage real companies, the companies that make products and deliver real services, for every problem. But as a matter of linguistics, I think stewardship requires something more inward and responsibility accepting. True stewardship involves undertaking meaningful obligations yourself. In this context, it requires coherent investing, engagement, and voting policies that emphasize sustainable growth and that recognize that human investors need, and this isn't just an Alan Alda kind of, I'm dating myself, but he was a crunchy granola type from MASH. It's not just somebody who wants, quinoa instead of ground beef. They need, as investors, human investors need, as an economic matter, companies that pay wages that are fair to workers and treat workers with respect. They need companies who avoid externalizing costs to other companies, taxpayers, and consumers, and they need companies to be environmentally responsible. And institutional investors, if they're going to help promote that kind of conduct by companies, it doesn't just require them to engage in talk, it requires that they match that with action, and that requires discipline and focus. And today, I'm also going to talk about what moving toward genuine stewardship might mean if there's a new administration in Washington. To frame some recommendations I'll make along those lines, I'm going to start by identifying the difference between the corporate governance system we actually have now in the year 2020 and the system that existed when most of our regulatory structures addressing institutional investors were created. I will then touch on the unsatisfactory outcomes that have resulted during the last 40 years when the power of institutional investors and the stock market over American public companies grew enormously and the protection for other stakeholders shrunk substantially. And after that, I'll discuss why trusting the institutional investor community to reform itself is not an adequate answer. Finally, I'll finish with what a sensible framework for updated industry regulation might look like, emphasizing that this reform, while essential to restoring greater economic fairness, is not sufficient unto itself. Now, let's start with why the corporate governance system we have is not your grandfather's, because we got to understand that if we want to actually make things better. Most of the regulatory structure that was set up was based on certain implicit assumptions. The first was that stockholders generally had a long-term stake in the company's best interests. Most stockholders were affluent. Most of them owned their shares directly for their own benefit, and they held them for a lengthy period of time, and there was relatively minimal turnover. The stockholders who were most active and vocal were those who had the longest term stake in the company. Most stockholders invested because they liked the companies and their management and did not interfere in the company's strategic direction. There were certain wealthy investors, I think of Thurston Howe from Gilligan's Island, and for young people, you can catch that on Nick at Night and answer for yourself the time-honored question, Marianne or Ginger. But Thurston Howe, people like that, were deemed to have so much money that without harm to society, we could let them invest in opaque vehicles on a caveat emptor basis, and we would deny those investments to less affluent investors who we thought couldn't take care of themselves. Then in terms of workers were largely dependent on pension funds and Social Security for their retirements, and they did not form a large segment of the investor class. Most public companies had a long-term lender who had a deep relationship with the company and kept a sharp eye on its ability to pay its debt and to weather tough times. When companies profited, they tended to create more jobs, pay workers better, and give back to their communities. Corporations had a national and often regional focus, and their managers, directors, employees, lenders, and even stockholders often had thick ties of loyalty to those communities. Corporate managers lived in the best part of town, but they didn't live in a different universe. There was a plan of internal succession, and corporate managers tended to live right in the community, again, in the best part of town, but in the community, and to be deeply engaged in company affairs. Now, in recent decades, those assumptions have really been turned on their head. Corporate stockholder bases turn over rapidly. That's probably slowed a little bit with the growth of index investing, but average turnover among active traded mutual funds is basically 100%. Hedge funds and other types of funds trade even more frequently. Most stock now is not owned by individuals, it's owned by institutional investors, but it's not just for the affluent. They increasingly have the capital of American human investors. And these institutional investors engage in much more portfolio turnover than was common in the past. The actual human investors who are invest through 401k and college savings programs are largely bystanders and do not get to vote. The most vocal and active stockholders actually have investment strategies most in tension with the efficient capital markets hypothesis. That is, they are by definition the closest to irrational and needing a guardian. And in particular, the most active involve hedge funds who only become stockholders usually after deciding to change the company and have no prior interest in its well-being and no long-term interest in its well-being. Even the institutional investors who represent diversified worker investors, or some people call it universal owners, such as index funds, have pushed managed to the market policies and have pushed companies to put immediate returns first, even if that involves harm to other stakeholders. The growth of hedge funds and private equity funds has been fueled not primarily by Thurston Howe and other rich individuals who bear the risk of losses themselves, but by other institutional investors like pension funds, charities, university endowments, whose soundness is important to ordinary Americans and society as a whole. The voice of lenders as a stabilizing and risk reducing factor has declined as corporate debt has been securitized, but without any corresponding increase in stewardship on the part of mutual funds and others who represent the investors who hold the risk of insolvency or downgrades. The tie between increasing corporate prosperity and the best interest of corporate workers has been eroded, with corporations not sharing productivity gains with workers and instead at the behest of market pressures, focusing on offshoring and job and wage cuts as methods to increase profits. Corporations increasingly have no national, much less community identity, and are willing to not only arbitrage their communities against each other in terms of seeking tax subsidies, but also to abandon their national identity for tax savings. Think of aversions. And top corporate managers have been promised pay packages way out of line with other managers. They in fact live in another part of the universe than most of us now. But in exchange for their lavish pay packages, they've been required to focus intently on total stock return, and they have to be willing to treat other corporate constituencies callously in order to keep their market employers happy and to reap the rewards of their pay packages. Now, under this radically different system that we now have, human investors are not citizens of the corporate governance republic. They're the voiceless and choiceless. And they are on the sidelines watching power struggles among the classes of haves, basically among the institutional investors themselves, who directly control the stock of the companies upon which our nation depends for its continued prosperity. And as I said, attention to this sector has lagged well beyond its power. Now, old tropes in some ways are responsible for this. Like there's some New Deal tropes, and it influences the Democratic Party, the party I'm a part of to this day, which is stockholders were good in this context under the New Deal paradigm, and management was bad. And that trope has persisted despite the change in identity of who the stockholders were. The focus of academics, the business community, and as I said, ironically, the Democratic Party has therefore tended to be on what bad managers were not doing for stockholders, society, or stakeholders, with little attention on the increased pressures public companies were facing from institutional investors. The obsession with agency costs that infatuated key academics like Dan Fischel and my friend Lucian Bebchuk, who you were honored to hear from earlier today, about company managers did not catch their fancy. They just weren't that into it. The assumption among these academics associated with the law and economics movement, despite their protestations to the contrary when anything went wrong, like the financial crisis, was that ECMH really meant that whatever could pump up the current stock price must be optimal, because the market and particularly institutional investors would price any externality risk. And if there's any harm, well, that government will come in and clean it up for everybody else. In focusing on individual companies, they ignored the fact that most investors are long the economy. They're long the economy, not one company, and that the sum total of externalities at specific companies and downward pressures on wages was less money for working investors to save, more economic insecurity, more taxes to pay, and more environmental and public harm. That institutional investors voted all their funds in one way, that means the socially responsible funds, the index funds, the active funds all voted the same way, even on stock for stock mergers. And that was okay, even though those funds had different objectives. That retirement investors got the same voting policies as quarter to quarter day traders didn't matter. Now, admittedly, some of us harbored some hope that in the institutional investor, consolidation, there could be some positive benefits. Maybe these mutual funds and index funds and pension funds that were long-term would actually put up directors as owner directors. And because they're stuck in long-term, and they would actually be stewards right on the boards. Maybe funds with long-term horizons would align their voting policies to the long-term nature of their investments. Maybe funds would monitor and check management pay. Maybe they would focus on seating directors who added business value and not just former politicians or academics. Maybe the funds would make sure that the right representative litigation was prosecuted where there was a real upside for the shareholders or society in terms of corporate governance reform, and discourage meaningless suits that had only a value for the plaintiff's lawyers. Maybe they would push stewardship and corporate governance policies that were in alignment. They would assess how much capacity they really had to vote, and they would support corporate governance voting policies and structures that would be sensible in light of their capacity to thoughtfully vote. Maybe the mainstream funds, and this is something my respected friends, Jeff Gordon and Ron Gilson wrote about, maybe they would fairly referee disputes between activists and companies and make sure that they were rationally decided in a way that was good for people who had their investments in the company, durably entrusted. Now, what we got was less edifying, and really can be fairly summarized as pushing companies to become corporate Californias. California's got great beaches, some wicked good hot dogs, tacos, other kinds of things, but its governmental system has been really a source of its erosion in the sense of calling constantly for referendums and plebiscites. And that's really what the managed to the market types have pushed for, and they were successful in getting the institutional investor companies to do that. And these constant plebiscites put pressure on company managers to squeeze other stakeholders, lever up, and to engage in the endless cycle of M&A, where you spin something off, then it's bought again, then it's spun off, and then you continue to hit repeat. And certain segments of the pension fund community in particular seem to emerge to just enjoy being, as people would say, a playa, like a playa. They're there, they're a factor, they're a thing. People have to listen to them. People hold conferences where they're gigantic shrimp that they can nosh on because they're got other people's money and they throw proposals into the table. And by the way, some of our academic friends love this kind of getting the mustard squirted on their Coney Island dog in public. So what ensued from this great developments? Paying CEOs with options and other forms of equity tied to total stock return. We ended classified boards. We turned withhold votes into pressure tools. We have annual say on pay. Everybody says we should have long-term pay contracts for CEOs that make sure and so we have to put that logic into effect. The institutions insist that we vote annually on pay plans and outsource the voting to ISS, except in a bad year when it's a vote on generalized outrage rather than pay. Then the ISS itself has its spice up the board policies. Let's just throw two or three activists into the mix. Let's set a lower burden to elect less than a full slate because, we really like our jambalaya spicy. And that's what public boards should be about. And then, of course, we vote the index funds and social responsibility funds in line with the active funds to save money. So socially responsible funds vote on social proposals in the same way as the active funds. That makes, that's cool. And we pressure companies to offshore, cut wages. We pressure them not to have prudent reserves. We ignore that these pressures encourage externalities, including pollution and excessive use of carbon. We ignore that this encourages companies to seek to please the market by polluting the political process as a way to survive. That these pressures resulted in inversions of American companies to tax havens that erode the ability of the OECD nations to fairly fund their societies, and also to havens that have less protective corporate governance. These institutional investors, rather than focusing on what really hits investors, like hitting the rocks, failures in risk management, have focused virtually all their proposals and energy around pushing for sell-side M&A premium and making companies more responsive to activist plays. There's been almost no proposals around risk management or any of the things when you think about the scandals and other things that led to Sarbanes-Oxley, Dodd-Frank, or other sorts of things that could have addressed that. None of the proposals are in that area. They're actually to the contrary, to make companies more of a plaything of the market. And then in terms of litigation, did the fund step up to make sure that it was only worthwhile? No, actually, they turned Mrs. Parnes into the Octomom, or Mr. Khan into the Octofather. If he is Mr. Parnes and Mr. Khan, they're famous individual plaintiffs. The thought was that if institutions refereed this, that litigation would be bought on a benefit to cost basis, that there would be less of it, but the suits that ensued would be meritorious and you would get better outcomes. Instead, public pension funds in particular proliferated as plaintiffs and drove a huge increase in the number of suits that mostly resulted in rents to plaintiffs' lawyers, costs to all investors and society, and virtually no benefits to stockholders. Now, what's resulted from these policies? We have profound inequality. The gain sharing in terms of what share of gains in productivity and profits has gone to workers has plummeted enormously in the US. See the work of Larry Michel in particular at the Economic Policy Institute, which has also been confirmed by recent work by Professor Summers and Stansberry. It's not just the effect of globalization that's isolated the US effect of our particular tilt towards the stock market and institutional investors and away from workers has had a unique US effect. But there's trends in the EU that suggest that convergence with US policies is creating some of the same dynamics. This has hugely harmed our ability to make progress on racial inequality because Black people were not part of the free economy until the mid-1960s. The reversal of the New Deal consensus and the rising power of the stock market has hurt racial progress in a huge way because Black people are much more likely to be in the working class and the lower middle class. They are much less likely to be in the elite stockholder top class. And they would have been unable to close the race gap or build wealth for themselves because the share given to working people and middle class people has been so profoundly diminished during the last 40 years. Corporate influence over the political process has grown enormously, polluting our environment and our overall politics. They have systematically used corporate power to denude protection for stakeholders, including workers, consumers, the protection we have against antitrust, and to shield information from the public about important developments like climate change and the dangers of opioids, resulting in huge social harm. They have systematically shifted the risk of their excessive risk-taking to the public, causing the need for repetitive, enormous public bailouts to the corporate sector. And in terms of this year, the pushing companies to run on fumes had left corporate America without the resiliency to address the pandemic in any responsible and humane way. Most companies would have had problems in the wake of the pandemic, no question. But we had 10 years of economic recovery and a huge tax subsidy to the private sector. And in weeks of the pandemic hitting, workers were being laid off, creditors were being stiffed because companies did not have the reserves that families are told to save for. They didn't have close to 6 months of reserves. They didn't even have a month's reserve. And then in terms of litigation, it's been a wasteful wave. So to be fair, though, the institutional investor community now bemoans some of these things, and they're talking about sustainable growth. They're talking about the need to respect other stakeholders. And some, like State Street, which probably comes the closest to walking the talk, are actually stepping up on things like corporate political spending. Some of them are voting for forum selection clauses to restrain needless litigation. And grudgingly, they're actually taking into account workers. And I'm hoping they'll actually add the employee name to EESG and call it double ESG so they actually recognize whose money they have. And for several years now, they've been talking about gender inclusion, but they were resisted talking about racial inclusion, but now with the murder of Mr. Floyd and other developments, and the fact that the essential worker class is so much more likely to be Black, and that Black people have suffered so enormously in the pandemic, they're even stepping up on that. So, but the problem is that most of this rhetoric remains just that, rhetoric. And most of it does not acknowledge that money managers' success in making American companies manage to the market was a substantial cause of these suboptimal outcomes. So we're at a moment of history right now, and it's pretty familiar, right? You got the elite that says, you know, and you see this in the Business Roundtable Institute, okay, we got it, we understand there's a problem now, we get it now. Now, but our bad, but just trust us, leave it to us. And for corporate law academics, think about Merrick Dodd. That was really his, Merrick Dodd gets a little pass on history, like Chief Justice Roberts gets a pass on the Affordable Care Act when he wrecked it. Think of the Medicaid expansion, think of voting rights. Merrick Dodd gets to play this game with Adolph Burley, the true New Dealer. But Merrick Dodd was really saying, hey, corporate America kind of understands these things, leave it to them. There's another school, the Burley school, the Orwell school, the FDR school, the school that I respect, which is, no, when an interest have responsibility in society, when they have a power over society, they have to have obligations to it. And that's what Burley was about. That's why Burley was a brains truster, a key member of the New Deal, and who actually during his lifetime signaled the rise of institutional investors and some of the concerns that they raised. And so I think I'm firmly of what I call the good Adolf school. And he's associated, as many of you know, with Columbia. And the good Adolf being Adolf Burley, that when a powerful group emerges in society, they have to undertake binding obligations to society. And we're in the current predicament because we failed to remember the lessons of history. And we didn't address the power of institutional investors and the resulting effects on companies. And we allowed that power dynamic to be exploited to unbalance the New Deal social democratic consensus that saved us from fascism and communism, and that provided a sound framework for a fair economy. So I think we need to regulate, and there's a couple reasons why. I'll just say that. If you look at what we've done in corporate governance, everybody assumed that we had to have government action. My friend Lucian Fairley said that he has written about the agency cost of institutional investors. And I'll say he has touched on that. But if you read my friend carefully, it's been mostly to say, you can't trust index funds to push companies enough to manage to the market. So be very careful. Do not regulate activists, even make them have disclosure. But in terms of public companies, sure, let's mandate say on pay. Let's mandate how many independent directors they have. Let's get rid of classified boards. Let's tell them that basically they have to manage to the market by having constant plebiscites. And he says, and others say, well, you know, and because stockholders are really weak. There's not enough proxy fights. There's not enough derivative suits to really hold them accountable. And we have really weak capital markets. But then we turn to institutional investors. Are there proxy contests against mutual fund boards? Do you really get a choice? Talk about cats and dogs, former politicians. That's your mutual fund board. Do you get a choice over your pension board? If you want to use the Wall Street rule, like they always say, the Wall Street rule is not enough for investors. If you're actually invested in companies, if you're a rich person invested in companies, you have the Russell 3000. You got all kinds of international companies. If you're an American investor who invests in their 401k, your money's kept in till year 60. That's older than, people have to be even more decrepit than I am. You're looking at a decrepit person. You have to be 4 years more decrepit than me to get your money out. Until that time, your only option is to hop to another fund in the fund family, right? But somehow in this space, no regulation is needed. We just trust that they're so aligned. And so there's been no parity of reasoning, frankly, about this. And also we don't deal with the fact that their alignment in terms of pay and other things is not nearly as close as actually of company managers, and their alignments of fidelity don't, no pun intended, aren't as much as people who run companies are with the interests that depend on companies. And our regulatory structure also just hasn't kept pace with things. The Thurston Howell exception hasn't kept pace with the fact that you now have pension funds, charities, university endowments investing in private equity and hedge funds without adequate disclosure. The disclosure requirements around activist investors and other investors haven't taken account of the rise of synthetics and derivatives. Nobody has talked about the changes in how companies acquire debt and the reduced voice of debt capital and what that means for risk. Nobody talks about the cost constraints under which mutual funds compete, and the fact that when we mandated stewardship activities and voting, we didn't actually mandate a certain allocation, and therefore we allow undercutting of the people who do it right by others. And we haven't talked again about the pay. Nobody talks about the alignment of pay in this industry like we talk about others. So, the overall effect of this inaction is we get managed to the market policies. They push companies to favor immediate returns over the best interest of their workers and other stakeholders. And it basically results in a pressure to cut wages, offshore jobs, and to lever up and not have prudent balance sheets. And if people say, like my friend Mark Rowe, that people still invest in R&D, yeah, they sure do. They invest in R&D and they invest in buybacks, not as much R&D, but they invest in that. And the stakeholders who get screwed the most are the workers. And that's ultimately us as Americans. And for 99% of us, more of our wealth comes from our job than anything else. And that includes the wealth that we use to save. So for that reason, I think that we have to regulate. And it's not a surprising dynamic where we are. If for 40 years, the arrow up for power is for stockholders and institutional investors, and for 40 years, the arrow down is the power of other stakeholders, particularly workers, it's not surprising that the distributional effects have been in the direction of the powerful interest at the expense of the weaker one. So what I'm going to talk about, and I'm going to skip for the interest of time to the solution, is that it's not enough for institutions to talk about climate change and put pressure on companies when something goes wrong. They need to align their actions with it. It's not enough to say that companies should treat their workers well. We need to see voting and stewardship policies for them that do it. It's not enough to say that they're going to be a fair referee for activist plays. They actually have to step up and have the information to do it and to make sure that they're thoughtfully doing it. It's not enough for them to say they want to be a good steward, but then push on companies so many votes that it costs the companies money to deal with, and no one in the electorate is really thoughtfully attending to them. That's not stewardship. And so I'm going to outline what stewardship might mean in a real world context in the current dynamic. And it's going to be a fast tour through some exciting policy reforms. But before I do them, I want to underscore something, because there's this tendency that people have to say, well, if we only do that, will that fix society? No one is saying that we should only do this. I believe that channeling the power of institutional investors is essential to a 21st century New Deal that restores fairness to our economy. It is not in any way sufficient. Okay, if we don't increase the wages and the voice of labor through labor law reform, living wage legislation, we're not going to get there. If we don't increase consumer protections, if we don't actually revitalize the environmental laws to address climate change, if we don't make the investments in basic research and infrastructure to tackle climate change and to revitalize our infrastructure and create jobs, we're not going to do that. But if we're not, and we also need to require public companies to disclose what they're doing on double ESG and to align their efforts with society's best interest and the best interest of their long-term investors. So we got to do all that. But none of that's going to work if the companies are subject to irrational pressures from institutional investors, and the institutional investors themselves don't have to act in a societally productive way and in a way that is in the best interest of their investors. So that's important context. This is an essential but not adequate part of a 21st century New Deal. So what needs to be done? Well, first we got to actually reverse and go entirely in a different direction from the Trump Department of Labor, which ought to be called the Department of Anti-Labor. Instead of gagging institutional investors who are actually taking into account double ESG factors because those factors are critical to their investors, we need to actually require them to do so. Index funds, in particular, retirement funds in general, have to understand that their investors are invested in a whole economy. They're not long a particular company. So it's very important that there not be increased externality costs that shift costs to other companies, that it raise taxes on workers, that externalize harm to consumers, and that slow overall economic growth. Actually, John Coates has a good paper on this. It talks about basically that we're becoming like the risk of becoming Russia, that where everybody's competing basically just on regulatory gimmicks. The sum total of that is not greater productive economic growth. And to the extent that the funds are actually putting pressure to arbitrage against working people, they're actually hurting their own beneficiaries. And they're actually, in terms of pension funds, cutting the ability of the pension fund to fund itself long-term. Most people need their job. And so these funds need to be required to actually consider these things and to make disclosure. And they should be disclosing how they take these things into account. And consistent with reversing the Department of Labor, all institutional investors should be permitted to do this, to be able to exercise their fiduciary responsibilities and to consider the interest of their investors as on economic and human terms in sustainable growth, in growth the right way that does not involve externalization of costs, that involves fair respect for workers and consumers. And all institutional investors should be allowed to do that. There should be no mau-mauing of them. And in terms of the disclosure requirements for all of them, they should have to disclose how they take them into account. These should be shorter than public company disclosures, but they should track ESG disclosure obligations that should be imposed on all public companies and large private companies. That's a whole different subject. But Senator Warren is right about this, and I've long supported it in terms of companies that have a social impact at least should be disclosing how they affect their employees, the environment, society generally, and consumers. The fact that you don't have public investors doesn't mean that you shouldn't be accountable for that. And that's also going to dovetail with another recommendation I make, because as we've said, many public institutions such as universities, pension funds, and charities are invested through private equity and hedge funds. And they're often exposed to the risk of these private companies through those. So it will actually create a virtuous cycle. Proxy advisory firms, I'm fine with them. They are a symbol of broken regulation. They only emerged because there was the imposition of requirements on institutions to undertake activity they did not wish to take. And so proxy advisory firms arose as regulatory insurance. My recommendation for longstanding is that you can only use a proxy advisory firm's recommendations if they are tailored to your specific form of investing, which means ISS and Glass Lewis should, if they want to give advice to index funds and index funds want to rely upon them, they should be making index fund specific voting recommendations that take into account the stuck-in nature of index fund investing. If you're a socially responsible fund, you should have to be relying on that. And these things should be tailored to what the fund is, or otherwise you can't rely upon it. I think that's just perfectly reasonable. Stewardship, I think there should be requirements to align your votes on corporate governance with your capacity to be stewards. If they really believe they can keep track of all those annual say on pay votes, and they really believe corporations managers should be paid on a year-to-year basis, then they should vote for that. But if they actually do not believe corporate managers should be voted to have year-to-year pay policies, and if they actually would admit that they can't take track of them, then perhaps, for example, they would support putting a quarter of the companies up for a vote every year on a 4-year plan. And so they could thoughtfully vote on it and monitor them. And there's time for requirement for that. And we also need requirements around free riding so that there's a certain level of effort at all funds to avoid undercutting of responsible funds by others who don't do it. We need requirements for stewardship on debt funds to rebalance things and to make sure that we don't just hear the voice of debt capital at the catfish level of the economy when there's an insolvency, but that debt funds are actually pushing governance and structural policies such as avoiding covenant light that help avoid the rocks and help avoid the risks to human investors. Most investors don't just invest in equity, and there's a lot of evidence that activist plays involve shifts in gain, shifts in value from workers and from debt holders to equity. Those things don't help humans. Gains in value help. And we need more of a voice from debt. And finally, on the funds, they need to, on litigation, boards themselves should have to approve any litigation before it's filed, and they should have to approve any settlement, and they should have to make a benefit to cost determination and explain why the litigation is in the benefits of their stakeholders in society and why any settlement is. Then turning to activists, it's pretty simple. We have an antiquated 13D. I don't want to get rid of activism, but we have a 13D that doesn't cover synthetics or derivatives. We have evidence, even my friend Lucian has got good papers on this with Rob Jackson about the amount of tipping that happens to the non-alpha dogs who are sniffing the butt of the alpha dog. And this is all to the harm of public investors and to companies. We are a laggard and a joke within the OECD in terms of our disclosure policies. And any responsible, powerful interest should have some corresponding responsibility. And there is no reason when you hit the 5% threshold, you can't file immediately. And if you can't file, you should have to cease trading. And it should cover all derivatives. And the SEC should develop a standard net long statement that has to be kept current by activists so that it's very clear how actually long the company is. And they should have to be disclosing any investment contracts or other things that bear on the length of their holding. So if they have to liquidate their fund in 3 years, but they're telling you that they're stuck in long-term and they're asking a company to distort its capital allocation and human capital policies for the next 10 years, that you should know that they're just giving you good advice. They're not really in there with you as a corporate citizen. They're just a bystander. And you can take that into account. And see what else we got here. I would also make it illegal for them to tip before their 13D comes public. And I would treat them just like an insider because it's demonstrated that they can have an effect on the markets just by announcing. And one way would be, frankly, to make an obligation that they treat their interest as proprietary and that they do not tip to others until they come public. Finally, in terms of protecting charities, universities, and others, it's one thing to exempt hedge funds and private equity funds from the same disclosure as mutual funds. I agree with that. You can't have them have to disclose immediately their positions, their trading. But there's no reason there shouldn't be standard track record information that they have to disclose that is verified and is subject to fraud liability. And they should have to disclose the terms they give to any investor if they're preferential. And they should have to make disclosures in those areas. And if you put that together with private company disclosure around ESG, you're going to have pension funds, charitable funds, and others who are much more able to invest in this sector with confidence and stop, frankly, getting the worst deal. And we'll also have public investors in general who are able to benchmark the performance of private equity and others against the mutual fund industry and to see what their performance has really been like. So, and finally, to help the industry, I would also put in place a financial tradings tax, which would help reduce fund hopping and help the more long-term managers. And it would also deter day trading. It would deter derivatives trading, which doesn't have economic substance and would be a useful way to fund climate change and could also be extendable to the OECD. And of course, we should close the carried interest loophole by having a real capital gains that applies on a 5-year basis and to make sure that private equity and hedge fund managers' labor is taxed at the same rate as the rest of us. Now, in my view, none of this will hurt this industry. This industry is federally subsidized. We all have to give it money basically every week if we save for retirement and if we save for college. But it will legitimize the industry, and one whose power has long outgrown its expected responsibilities. And in my view, if you do these things in concert with the 21st century New Deal that focuses our economy on sustainable growth, environmental responsibility, and most of all, the fair treatment of workers, that we'll have a more prosperous and equitable America. And we'll actually expand the class of Americans who have the means to invest with this industry for college for their kids, retirement for themselves, and to enjoy genuine economic security. All of that just involves making sure that a powerful segment of our economy's responsibility be aligned with its powers. Put another way, all that I'm asking is that the haves do a little for the common good. I don't think that's too much to ask. And I apologize to everybody if it was awkward watching someone give a speech on Zoom, and I appreciate very much my distinguished commentator for her patience with my late delivery of my paper, and I'll turn it over to her.
Great, thanks so much, Leo. Providing comments for 20 minutes will be Rebecca Henderson from Harvard. Rebecca, take it away.
Eric, thank you very much. It's my pleasure. I thought I had unmuted. Okay, it's my pleasure to be here and an honor to comment on Judge Strine's paper. Leo picks up the agency issue that Lucien highlighted in the first session this morning, but he takes it, as he says, in a very different direction. He suggests that the heart of the agency problem is that the institutional investors are not representing ordinary Americans who would like action on climate change, good jobs, higher wages, and to pull money out of politics. I think it's a really interesting idea, but I think there's an important distinction that Leo glosses over in his paper that his argument would benefit from introducing. And that is the degree to which the agency problem reflects a problem of time horizon and the degree to which it represents a problem of systemic risk or collective goods, as John highlighted in his paper in the second panel panel today. What do I mean? Leo seems to oscillate between thinking the fundamental problem is because of agency problems and other issues, institutional investors are pushing companies to focus too much on the short term, that the entire capital markets are overly focused on the short term, and that this creates very bad decisions, notably perhaps not investing sufficiently in workers for the long term, locating plants overseas that should be onshored, and so on. This is an old idea. Certainly when you talk to corporate executives, they will often complain that the markets are too short term. And it's one to which I am at least partially sympathetic. And I think one way of thinking about ESG metrics is that they help correct this market failure, if it is a market failure. Because of course, the conventional reply to this is, well, if there was money in the long term, investors would go to long-term oriented companies and we'd be all set. I spent the first 20 years of my career studying why it was so difficult for large organizations to change. And so I put more credence than most on the importance of standard operating procedures, ways of thinking about the world, and existing metrics in shaping strategic choices. And so to me, it is quite plausible that there are long-term opportunities that firms are not picking up that would benefit other stakeholders. And indeed, that the kinds of policy recommendations that Leo has laid out for us that would have the effect of slowing the capital markets down and giving corporate managers a little bit more space might indeed be value enhancing for all stockholders, and particularly for employees of the firms and for other stakeholders in the society. But Leo is making another really interesting point, I think, which is he's pointing to externalities That is, he says things like the whole economy would be better off if we paid employees more. And the whole economy would be better off if we tackled the problem of climate change. And this is really echoing Professor Gordon's point in his second paper, which is we're facing these massive systemic issues, which, and this is the reason I think the distinction is important, may not be in the interest of any single firm or indeed any single investor to correct. So here's my worry. When we say fix the agency problems, it will have, so that institutional investors better reflect their ultimate owners, I'm completely on board. I think it will get you those problems that are essentially long-term problems that perhaps we haven't been focused on sufficiently. It's not clear to me that it will get the collective action problem. To be specific, I have money in a 401k and I care enormously about climate change. I'm a verified tree hugger. But do I want the firms in my portfolio to invest against climate change if it reduces their returns? Well, I do. But, I am a very privileged person with deep financial resources. It's not clear to me that if I'm, working 2 jobs and really dependent on my savings and my retirement funds for a healthy retirement, that I'm going to be willing to make that trade-off. So I think that's an interesting question that we really must keep in mind here. And in order to address it, I go in 2 directions. One is where Leo opened by saying, Leo raised this point, which is many of these problems can only be addressed by public policy. That climate change is a public good, decent wages and real stable working conditions are public goods for the whole society. We need good public policy. Check. What that suggests to me with regard to this conversation is that every asset owner who cares about these externalities has very strong incentives to, in Leo's word, make sure the firms they invest in are no longer polluting politics. And if there's one thing we would try and get alignment on, it would be to try and pull the kinds of resources out of politics that have led to 70% of Americans now believe, and this is before the pandemic, that the political process is basically rigged in favor of those with money and power, which is very destructive. And we could talk more about the corruption of politics, but it is very real. So I personally would love to see institutional investors pushing hard against this issue of political spending and pushing the firms in their portfolio to contribute to data to centers like the Center for Political Accountability, so that we have a really clear sense of what they're spending on who and why, and then asset owners can have some sense of what's going on. So let's add that to ESG. The other issue is, of course, asking whether we can have collective action. And this is the issue that John raises in his paper. Massive systemic risk to the long-term health of the economy. Everyone has an interest in addressing it. Can we somehow trigger the collective action that is necessary to address it? Is it appropriate for the big fund managers to work with each other? Bracketing antitrust concerns, of course, which are a major issue, but assuming that antitrust concerns are not an issue, and we clearly need to understand that more, should we be excited when institutional investors work with each other to push the firms in their portfolio to address an issue like climate change or living wage? And here I think Leo adds something really important, which is individual investors cannot solve this collective action problem themselves except through politics. Certainly not through their investments, without a lot more choice in the retail investment market and mandatory disclosures. Perhaps we could argue that institutional investors are exercising their fiduciary responsibility by working with other investors to address these major systemic risks. That every one of their investors would benefit enormously if we solve the problem of climate change. And thus it is indeed in their fiduciary duty to address this problem. Now, one concrete example of that is the stance that Hiro Mizuno took when he was chief investment officer at the GPIF, the Japanese Pension Fund. As I'm sure you're aware, the Japanese pension fund is the largest pension fund on the planet by some measures, with 1.7 trillion dollars under management. And Hiro came to believe that he had an overwhelmingly fiduciary duty to address these problems of systemic risk, particularly social inclusion and climate change. And that it was incumbent on him to start pushing his asset managers to make progress in this direction. And he joined forces with other asset owners in groups like the Climate Action 100 to sort of kind of facilitate this collective action. So we do see at least some asset owners, or at least some institutional investors who represent ordinary people, sort of pushing in this direction. As he pushed, Hiro found a couple of problems, which let me just put on the table because I haven't seen them discussed during the course of the day as much as I would have expected. One is the question of who's going to develop the information to have these kinds of conversations with every firm in their portfolio. Who is going to have one-on-one conversations? Every asset manager, of course, has a deep incentive to free ride on the efforts of all the other asset managers. Does that mean that we should rely more on the rating agencies or less? Does it mean we should have a public body that collects the kind of information necessary to address these public goods issues and makes it freely available to all asset managers? How do we think about supporting the strong temptation that every asset manager will have to reduce its investment in this area? And we heard from BlackRock that they have a team of 46, and it's the largest team in the industry, and that's fantastic. But 46 people, like that's it, you know, for an economy of this complexity and conversations of this kind of nuance. So I wonder if, in addition to some of the legal reforms and policy ideas that Leah raised, whether we need to think very specifically about where the information will come from and who will pay for its provision. Eric, I think that's it. So I'm happy to finish on time and leave some time for Q&A.
Excellent. Thanks so much, Rebecca. I appreciate it. Great comments and a terrific presentation. Leo, do you want to say anything in response to Rebecca, or shall we?
I just want to thank Rebecca for her fantastic comments and for bailing me out, Rebecca, because you and I have a shared view about corporate political spending. And in trying to be somewhat on time, Eric, I left out, as Rebecca knows, a part of my paper that actually advocates specifically that for stewardship in this, and that would require corporate political spending to be approved by stockholders by a supermajority, and that any spending plans that were approved by stockholders have to accord with the company's ESG values. And so I fully support that, and I agree with Rebecca. And I also want to say that I agree with Rebecca too about the collective action problem. And I focused today, Rebecca, on the stewardship of institutional investors. But as you know, I have a paper that tries to move the dynamic, move the needle a little bit on all the things. And it actually goes a little bit to your point about information. I think that it's tremendously important that we update the mandate of the Securities and Exchange Commission to give them the authority to require disclosures in the area of ESG, and to allow them, Rebecca, to consult with agencies like the EPA and the Department of Labor so that they have input from them. And I think if we can do that and actually cooperate with some of the international standards thing, we'll begin to close a little bit that information loop that you're talking about. And that will help with this stewardship gap. And I also want to find a thing, I think Rebecca's very on point about the antitrust issue in this sense. People mau this industry and try to gag them from cooperating. They don't apply the same thing to any other industry. And the reality is these BlackRock and State Street and Vanguard and Fidelity are fierce competitors, but there's no antitrust reason why they can't have a center of the plate investment institute like the CII that would a part of the CII that would actually collectively focus on externality reduction, real economic growth, and climate change. I don't think that proposes competitiveness reform, I think there are some, frankly, academics, Rebecca, plaintiffs, lawyers, and activist investors who discourage that because it's not in their interest. But I think as an academic community, putting to rest this myth that it's some sort of antitrust problem would actually be quite useful. And I think with some collective action along those lines, it could rationalize some of the stewardship resources. And part of why I did try to recommend in an imperfect way some minimum, Rebecca, of investment in stewardship by all funds is to cure that problem of the free riders and the undercutting. But I really appreciate your comments there, are tremendously helpful.
Excellent. So we have a few minutes for Q&A, and I've already seen the Q&A chat room lighting up. So if you are in that chat room and you would like to relay that question personally, please raise your hand. I also, one of our folks who's in the participant room, Ron Gilson, has asked to ask a question, and he's disabled from raising his hand. So Ron, if you are out there, let me start with you.
Okay, well, I think I'm unmuted now.
Yeah, you're
okay.
Good.
This is just a quick one, and it builds off of Leo's comment that we didn't learn the lessons of history. Leo's not as old as he makes off. Some of us are even older. The Investment Company Act of 1940 was adopted 11 years after Wyatt Earp died in Los Angeles, not in the gunfight at the OK Corral. The point I want to make is Leo's description of the bad moves over the period starts before the shift from defined benefit plans to defined contribution plans, the shift from giving the responsibility for making investment decisions from people, from companies that had an obligation and had the capacity to hire good people and push them into mutual funds. And it's worth remembering why that happened. It happened because we stumbled on the fact that companies had massive underfunded past service costs, and we weren't requiring them to put it on the balance sheet. Once we passed ERISA and required it to go onto the balance sheet, the good news was all of our long-term companies terminated their defined benefit plans and shifted them to defined contribution plans. I make this not to shift the blame, because there's plenty to go around. But this notion that there was a magic period in which management was local and worried about their employees. Boy, when those past service costs had to go on the balance sheet, they sold the workers down the river. So it's not. My point isn't Patrick quoted Twain earlier in the day. There's another one. History may or may not repeat itself, but sometimes it rhymes. And what you're describing is a rhyme from the set of events that happened way before takeovers, way before there were significant institutional investors playing the role that they play now, so that as we think strategically, the history we're talking about, I think, is too short, and there's nobody in this game that's got a white hat.
Oh, no, Ron, I totally agree with you. So I didn't mean part of, if you saw the difference between the system as it is now and the thing really was, it had the point about most workers were invested through pension funds and stuff. So I totally agree with you on the arc. And I don't mean to villainize. I mean, there are people in this who ought to be villainized, but I don't think that the shift is necessarily entirely responsible for that. I don't think, for example, the people who did the proxy voting mandate in the 1980s understood the implications of what they're doing. I don't think that they were evil, but I think they were short-sighted. So I fully agree that this is a long arc. And I take it we both agree that the regulatory structure is way outdated and doesn't actually match the system that we have.
Well,
Is
and
that fair
because
to
let's
say?
remember, in when the gunfight at the OK Corral took place, there weren't no one had automatic weapons.
No, and that's what I mean. I mean, even the notion that our disclosure regimes don't cover derivatives and synthetics is crazy, right? And the idea that it takes 10 days to report, that was in 1967, the summer of love, when you actually had to prepare a document and deliver it to Washington. And the fact that we haven't updated any of this, I think, is part of what we're saying, right? Is that there ought to be a 21st century regulatory regime to deal with the 21st century economy. And you're saying that my point about a 1970s era regulatory regime, I'm probably wrong. It's probably more like 1950.
And the problem we need to confront is less the regulation of an investment advisor, investment funds, but how we want to save for retirement. Because we ducked that after World War II.
Oh, no, but that's one narrow thing. I do not think that you can ignore the shift in gain sharing in terms of the importance of those stock market and institutional investor powers on that. And that if you don't get enough pay, you don't get to save. I mean, the 401k threshold is already a reproach for most ordinary people, even well above the median income. No person who's an ordinary person puts in close to that level. And so if you want Americans to save for retirement, they need to actually get fair wages.
No disagreement.
So next on the queue, we had Marco Becht. Marco, are you still out there?
Yes, I am. So we're obviously going to talk about UK in the next session, but I thought, given the comment that Leo made about collective engagement last, I thought I might just ask a question about it. Of course, in the UK, you now have the Investor Forum, which seems to work very well. And you also have in Canada the Coalition for Good Governance. So there are other countries and neighbors outside the US that are practicing precisely what you called for. So is the absence of these kind of mechanisms or initiatives in the US, is that due to the law, or is it the politics, or what is it? You probably know the answer, but
Marco, you could be more right. And Marty Lipton and I and others who are interested in sustainability have pointed to the institutional investor community, to the Investors Forum in the UK as an example. I think one of it is that the origins of the UK institutional investor community are quite different from our own, and they come more of a pension fund dynamic. It's not surprising that the Council of Institutional Investors, which has a lot of pension funds, particularly public pension funds, is a collective organization. Our mainstream mutual funds are fierce competitors. And so I think in the US, that's always an odd thing. And as I said, I think there's been an exercise in academic and political intimidation of the space. People affiliated with the hedge funds have really put it in the ear of the mainstream mutual funds that if they collaborate, they're at legal predicament. They're not necessarily inclined, Marco, to want to collaborate, because one of the most foolish pieces of literature I see out there is the idea that these folks the index funds are in some cahoots with each other. They undercut each other all the time. It's one of the real stewardship issues. And so it may be a great theory because they're co-invested, but they're fierce competitors. So I think we need to get around it, but there are some really social and political dynamics that I think are different in the UK. I think the Investors Forum, though, is a good model, and we ought to be learning more about it. I think some of the stewardship efforts, for example, I've written an article about the Comp Committee becoming a broader workforce committee, Marco. And, one of the inspirations for that, besides my own fascination with, treating workers better, is the move in the UK, which I believe the Investors Forum supported, to have a board level attention to the workforce. So you're so right that we need that international lens. And one of the great things about this institute is having that. For example, I'll just put a point on it. There's a lot of silly, by some people I admire, literature that stakeholder governance really can't work. And it's like Germany and Scandinavia and most of the OECD does not exist. and they don't realize that, you know, there are other models out there than the US model, and that they're pretty tolerably successful.
I mean, as a German, I have to point out that Dieselgate did not happen in Britain. So.
Oh, no, I'm not saying everything's perfect, Marco. What I'm saying, though, is in terms of a high functioning market economy with a model of corporate governance in which there is more of a multi-stakeholder thing, we have many models around the world, and the US is actually more of an outlier, as you know, and part of the benefit of the Institute is actually to have that collaborative, you know, kind of input. And we in the US are often wear blinkers. And, you know, just like the Brits don't understand that the name soccer is their own, that we in the US sometimes don't understand corporate governance outside our borders. Hey, Eric, Michael Schreg has asked a question about how on earth I reconcile something with an opinion I wrote in 2018. Does Michael remember the name of the opinion?
I'm not sure. I don't know if Michael's
Okay.
mic'd up or not.
I would just say this to Michael. When I'm a judge, I apply the law of my state. When I write, I can speak about what things ought to be. And I believe it's really important to understand what the is and not confuse it with your ought if you actually want to move toward your ought. So it may be that I wrote some opinion that is at odds with my normative views, but that's because I was wearing a robe and I take that very seriously.
Maybe I can jump in and ask a question to both you and Rebecca. And you know, Lucian's first panel dealt an awful lot with trying to think about analyzing agency costs at the index fund level. And then Jeff's was, you know, very much engaging this sort of question of systematic reforms and what was and was not possible. In addition to, you know, what in the US certainly was a big deregulatory movement starting in 1980 and going through the 2000s. To what extent does our ability to actually solve agency problems sharpen incentives of managers in the direction of shareholder return maximization? Does that create a problem for us? Is there a role for agency cost if in fact there is? This is the solution here is going to be trying to figure out how institutional investors and corporations themselves are going to engage in some form of self-policing and raising the tide general.
Well, I let Rebecca go first.
So I just published a book called Reimagining Capitalism in a World on Fire. And to many people, when they hear that, they're like, Rebecca, business saves the world? Like, seriously? And so to your point, Eric, you could imagine a world in which we reduce agency costs and the pressure on firms to get even more focused on the bottom line would go way, way up. As I said, I think there's an important class of investments that are in fact NPV positive, that if we had investor pressure focused on the longer term and on a wider range of metrics, would indeed come up and be supported. But in the large, might it be a problem? Absolutely, it might be a problem, because so many of the problems we face are fundamentally collective action problems and can only be solved through public action. And at the moment, we have an equilibrium where every firm has an incentive to try and distort the political process in their own favor. And that's not a great equilibrium. And so, you know, pressure to do more of that would be hugely counterproductive. So yes, huge issue. But that's why I keep jumping up and down and saying collective action problem. Is it really maybe it's in my fiduciary duty to act collectively.
But I mean, it's also a question, right, of the better angels of our nature. And if you play like I hugely love the game of soccer and I love the game of basketball. If you play a game and the referee doesn't enforce the rules, the game does not move in the direction of the most sportsmanlike players. By the end of the game, everybody's kicking each other. And that's, and when you mention agency cost, Eric, I think what we have done is we've reduced certain types of agency costs. Those where there's any incentive, to be honest, to put anything other than the marginal traders' interest first. We have ignored the actual, diversified investor problem. We've ignored the creditor problem. We've ignored the fact that the residual claimant model is so primitive and so non-descriptive of the real world that it ceased to be taught. What I mean by that is, if we had a summing up every 20 years and the stockholders could just get the residual after all the workers in society and the externalities were paid, it might work as a model. But there's probably no group of stakeholders that actually collects more on an ongoing basis than the so-called residual claimants and sticks the rest with the rest. And so I think what we're talking about is, I believe with product market competition, Rebecca, that's intense, that already reduced agency costs, frankly, much more than anything else. And we keep forgetting that. Competition, competition, competition. Annual elections in Delaware. I've written a thing called the Soviet Constitution problem in corporate law, which is that everybody would talk about Europe, actually, Marco, about how Europe was stockholder heaven and the US was like the stockholders were weak. And it was like saying that the Soviet Constitution was the greatest, exemplar of civil liberties because you read it on his face. And I think, Eric, with the vibrant takeover markets that we have in the US, the vibrant election process, the collectivization of the industry, the product markets, it's very difficult to see how companies can survive if they're not profitable. No worker wants to work for an unprofitable company, but these externality costs and the risk of doing things the wrong way, I think, are what requires, I think Rebecca and I agree, to address that. And that's where the corporate political spending comes in. I did an article called Corporate Power Ratchet. People forget Lewis Powell. Lewis Powell should be associated with Milton Friedman at all times, because Lewis Powell, Justice Powell, called for the weaponization of corporate resources to go to war on the regulatory state. And it was the combination of the Friedman doctrine and loosening the rules of the game that brought us here. And I think what we're talking about, Eric, is having a strong accountability structure for managers for profit creation, but one that's rationally aligned with the real interest of investors. And that gives them a little bit room. I just have a hard time seeing how they're going to loosey-goosey. And in the United States of America, we have the lowest level of self-dealing and corruption anywhere on the earth. That is the pride and joy of our corporate governance system. And all stakeholders are aligned in that. No worker, no consumer wants management theft. And we police that very strongly in the US. And so I think there's really little risk that we're not going to focus on competitiveness in the right way. But if we don't do something about competing on the wrong dimensions, then we're really eroding anything. And frankly, we're opening the door to really nativist division. By not having an economy that works for everybody, the white working class is divided against the black working class, when if we frankly paid everybody more fair wages, we would close racial inequality in a non-racially direct way. And we would ease white economic insecurity, which would reduce that. And so what we're really talking about is whether we can move to a sort of what I would call a virtuous incentive system process that focuses on sustainable wealth creation. No one is talking about making the for-profit sector into a nonprofit sector. No one.
Great. So that went by fast, but we are out of time. I guess as Wyatt Earp said, fast is fine, but accuracy is everything. So I want to thank both Leo and Rebecca, and I apologize to those of you who are in the queue and we weren't able to make it to you. We're going to be reconvening at Eastern time, anytime, 25 after the hour. We're going to be taking about a 6-minute break. Thanks a lot.
Thank you all. Thank you, Rebecca. Thank you, Eric.
Thank you.
Marco.
Mats, hello. We are live, huh?
Yes. You can
So
hear
we
me?
start at 25.
Very good. Excellent.
Do you want to raise yourself a bit? Because you're a bit
I
cut
can't
off.
see myself, so let's see if I can.
Yeah, you're cut off about from your chin.
I can't even see my. Is this better?
Okay, now we can see. Yeah, we can now see you down to the bottom of your tie. No, it's just right. Perfect. Okay.
Good.
Yeah.
I can't see how do I get to see myself?
There's normally a separate window where you can see yourself.
Yeah, there should be. Blah, blah, blah. Oh, what the hell? You just tell me if I'm not perfect.
No, you look perfect, Mats.
Very good. You know, in Sweden, Sweden probably has the most shareholder-friendly company law in the world.
Well, I think we can debate that on the panel. I think the Brits would claim that they are more friendly, but I'll leave that to Dan and Dionysia. So
I don't know. Leo, are you still on?
I claim Brazil has the most controlling shareholder-friendly laws in the world.
Leo is not there now. Well, we've had this. I had that discussion with him before, so. You know, Marco. Marco.
Yeah, I'm still here. I haven't gone.
You know, we have a curfew here in Paris.
I was twice in France during the summer, and it was predictable.
Yeah, but now I'm in the office, right?
Well, who knows?
And I will have to leave after 9 o'clock.
Who knows where you are,
I can't go
Mats?
out after 9.
I mean, it could be anywhere. This could be a real or a virtual background,
Yeah. No, I'm actually in the office, and I.
Okay, I just got the signal that we should start. So let me just check. So I've seen Dan, I've seen Mats, Dionysia, I've seen Mariana's here. Is Fred here? Fred Samama?
Yeah, now I see myself.
Fred, you're here?
Yes, I am.
Oh, great. Okay, so we can start. So welcome to the last panel of the day. We have the title Stewardship, Hedge Fund Activism and Controlling Shareholders. What can and cannot be learned from the UK? Okay, now, if you ask me about the things that cannot be learned from the UK, I could be impolite and give you a list like, tracing apps and all these kind of things, but that's not what we're here for. We're here to talk about stewardship and corporate governance. And it is a fact that the UK is a master at corporate governance, and they're also very good with words. And they have been an exporting nation of corporate governance practices and ideas from the outset. And we are here to discuss this with distinguished colleagues. So first of all, we will have two presentations, one from Dan Puchniak and another one from Dionysia Kadeluzu. So Dan is Canadian, but is being transported to Singapore. And Dionysia is originally from Athens and works in London. My name is Marco Becht, by the way, and I'm German and I work in Brussels. So that's a good start. And then we will have a discussion of their presentations, which is going to be led, first of all, by Mats Isaksson, who is a Swede who's been running corporate governance things at the OECD forever. I think ever since you drafted the first governance guidance with Ira Milstein, in fact, so there's a loop here to the Milstein Center. And then, of course, we are going to have Mariana Pargendler, who is joining us from Brazil. And then, last not least, we have Fred Samama, who works for Mundi and who's one of the world's global experts on anything to do with responsible investment and climate change. So I'll not take much longer. Let me just say 2 more words about the UK. So of course, the UK in some sense invented the corporate governance code with the Cadbury Code. And this has been a smashing success. In fact, if you'd asked me at the time which would be the first country to copy it, I could have given you all sorts of guesses. Maybe the US. In fact, it was France, which, you know, sort of like threw me. Now, Mats remembers this very well because, of course, when the French copied the UK code, British thinking and British reality hit the reality of the world, which is that except the UK, the US and Japan, most other countries have, of course, something called a controlling shareholder. And the UK code didn't quite fit, but all the same, it was adapted in many different ways. And you now have corporate governance codes everywhere, including the US. Now then, at some stage, and the original codes already included some provisions, not just directed at companies, but directed at investors. There were recommendations of what investors should do. And that's, of course, not completely logical, because if you have a document addressed primarily at companies, why do you have something in there that's addressed at investors as well? It's not the same target audience. So Britain realized this at some stage, and then they came up with 2 ingenious insights. One was to separate the 2 documents, which makes complete logical sense. But that's not enough. You also need something else. You need to have a good name. And they invented the word stewardship and stewardship code. So we know that corporate governance codes are pervasive, and we've had challenges implementing them, for example, Mats, with the OECD principles. And we now have stewardship codes. And this brings us straight away to our first 2 presentations, because they're about stewardship codes the stewardship code originating in Britain, traveling the world. How has it traveled, and what does it look like when it is arrived in other jurisdictions? So with this little introduction, I give over straight away. I think Denisa, you go first. Is that right?
Yes,
So
that's
the floor's yours.
Thank you, Marco. Let me share my slides first. Marco, can you all see the slides?
Yes, we can see them perfectly.
Yes,
yeah.
perfect.
Yeah.
Thank you. Thanks a lot. So hello, everyone. Hello, Marco, and thanks for putting the global stewardship into perspective. Like previous speakers, I would also like to say a big thank you to Jeff for inviting me. And of course, special thanks to the Milstein Center of Columbia University, and of course to Elaine for making this happen. And I'm truly grateful to be included in this panel. So today, together with my colleague and very good friend, Dan Pachniak, we are going to shift a bit the discussion, and we are going to be speaking to you about the global development of stewardship regulation, drawing from an extensive comparative analysis of stewardship codes that have been adopted across 19 countries on 6 continents. Of course, when I'm talking about stewardship as a form of regulation, I understand regulation in a much broader way, as including not only state-driven law, but also market-invoking regulation. This research is part of a large project on global shareholder stewardship that brings together 33 academics from 27 different universities around the world. The Global Shareholder Stewardship Project began in late 2018, when Dan and I started discussing stewardship. And the inaugural event was a global shareholder stewardship conference that took place in London last September. So the conference was the first to examine the plethora of stewardship codes around the world, and concluded that despite the apparent global convergence of stewardship codes, especially in terms of their form, their content, and the number of principles, the codes significantly differ in application and scope. And what is more, the underlying motivational purposes of the adopting countries vary considerably also. So the conference papers turn to book chapters and will be published as part of an edited book on global shareholder stewardship in 2021, and you can find more information about the project and the conference report and some short videos from us on the project's website. So to understand the global trends on stewardship regulation, I think it is important to understand where and how did stewardship started. And I think that Mark already addressed some of that in putting stewardship into perspective. So UK policymakers had long regarded institutional shareholder engagement as vital to corporate governance of public companies, but had deliberately sought to induce institutional shareholders to develop their own self-regulatory responses to public concerns arising from underperformance. So the first preliminary stewardship initiative, even though the word stewardship was not really used back then, can be traced to the statement of the principles on the responsibilities of institutional shareholders, which was developed by the now dissolved Institutional Shareholders Committee back in 1991. And the committee was set up back in the 1970s by 4 institutional investor associations in the UK, the one on pension funds, the unit trust, the investment trust, and the insurers. And the ISC statement set out non-binding best practices for institutional investors and their agents in relation to the responsibilities in respect of UK invested companies. So those principles were an attempt by the institutional investors to self-regulate themselves, thereby pushing back any government intervention in respect of institutional shareholder engagement, especially following the Miners Review in 2001, which recommended a statutory duty on asset managers to intervene in companies by voting or otherwise. This 1991 statement was slightly revised in 2002, then again in 2005 and in 2007. And in the wake of the UK banking crisis, the role of institutional investors was again brought to the fore, especially because of the Walker Review of 2009. So the critique back then was that institutional shareholders have been uncritical of risky business practices in their invested banks and should have monitored board risk management. So on that basis, the Walker Review proposed that those who have significant rights of ownership, like large institutional investors, they should also have a stewardship duty. So as a response, the ISC turned the principles to a code to encourage institutions to be more active and engaged. This code received bottom-up acceptance among institutions in the UK, and as a result of the Walker recommendation, the FRC adopted that formally as a stewardship code in 2010. So in 2010, the stewardship code was adopted formally by the FRC, and that's the first time that the word stewardship appears in a title, in the title of such initiatives, which is a choice that perhaps reflects the expectations for institutions, that to engage with their invested companies is a matter of stewardship. The code is addressed to asset managers and asset owners investing in UK public companies and applies on a comply or explain basis. And it is faithful to the spirit of the previous ISC code and focused on stewardship as a basis of shareholder engagement and monitoring. And that's why it has 7 principles focusing on monitoring, escalating activities, conflicts of interest, development of stewardship policies, and reporting. Following the case review's emphasis on promoting stewardship across the equity and across the investment chain, the FRC revised the stewardship code in 2012. So the 2012 version brought a much more expansive form of stewardship, focusing not only on engagement, but also on stewardship as a means to improve the accountability of institutions to their own clients and to their own investors, and achieving efficient investment management. But essentially, the 2012 version has the same 7 principles, and that's why the 2 codes together have been described as the first version or the first generation of stewardship codes. You shouldn't forget, though, that those codes are voluntary. So this means that institutions that do not in reality regard engagement as key to their investment management approach may nonetheless feel pressured to conform and thus sign up to the code. So these institutions may take a cosmetic approach to the code in order not to incur too much cost, but they use their signatory status to brand themselves to investors. So the FRC identified this issue of patchy compliance with the stewardship code, and that's why I introduced a tiering system in 2016 to distinguish between those signatories who are genuinely active from those that free ride on the stewardship brand. So despite the improvement in reporting following the introduction of the tiering exercise in 2016, the Kingman review in 2018 concluded that the stewardship code, whilst a major and well-intentioned intervention, is not effective in practice. And according to the Kingman review, the stewardship code focused too much on the procedural aspects on engagement, but not on real outcomes. So the FRC directly responded to those criticisms and revised the UK code with a focus on outcomes. And the 2020 version of the UK code introduced a significant overhaul to how we understand stewardship. The code has 12 principles. It's not only about engagement anymore, but it's also about investment management and about what Jeff describes as systematic stewardship. And there is an emphasis on ESG factors. So what I try to show you so far is that UK policymakers have expressed their faith in the capacity of institutional investors to act as stewards of listed companies, and have over the last 20 years promoted policies aimed at encouraging them to become more engaged in the corporate governance roles. But the question here is, can we really expect from institutional investors to act as stewards? And do stewardship perceptions of the investors themselves cohere with policy narratives? So in the paper I prepared for this conference, I address these questions by providing new and original evidence from the point of view of activist hedge funds that have signed up to the UK code, to the first generation UK code. The choice to focus on activist hedge funds is not by chance. First of all, as we saw from the earlier panels, activist hedge funds are the best candidates for stewardship because they focus on firm-specific investment. But at the same time, activist hedge funds, actually there is a negative perception of activist hedge funds, especially in the US debate, but also elsewhere. And activist hedge funds have been criticized as unfaithful corporate governance participants that, look for short-term profit. So the question this paper tries to address is the way activist hedge funds and similarly active asset managers in the UK understand stewardship. I'm not going to delve into the methodological details, but the study constructed a textual data set comprised of all the public statements of those 19 activist signatories. The final corpus consists of 28,438 words, which were analyzed using the method of automated content analysis and structural topic modeling. So what are the key findings of the analysis? So the empirical findings elaborated that the notion of responsibility is much more impeded in the rhetoric of tier 1 signatories compared to tier 2 signatories. So in other words, tier 1 signatories seem to regard themselves as able to carry out a governance role for corporations in the wider public interest, whereas on the other hand, tier 2 signatories seem to understand stewardship as a corporate governance mechanism and associated with voting and best corporate governance practices, such as independent non-executive directors. Now, in terms of the extent to which the rhetoric of stewardship coheres with the UK stewardship code principles themselves, the empirical findings suggest that in terms of disclosure and transparency, the statements do not really focus too much on that. So this seems to confirm the earlier criticism by the Kingman review. But on the other hand, what I found, which is maybe surprising, is that tier 1 signatories place a heavier emphasis on ESG compared to the code itself. So in other words, in terms of responsible ownership, it appears that the signatories, at least in terms of the statements, went a step further from the UK code itself. So it is clear from the findings that there is a gap between tier 2 and tier 1 statements. So it seems that tier 2 signatories understand stewardship in a much more instrumental way, as relating mainly to engagement and monitoring, whereas on the other hand, tier 1 signatories appear to have a more social and environmental friendly orientation in the way they perceive stewardship. So their understanding can be described as more enlightened in the sense that they've used stewardship as a means to address major societal goals, including climate change. So the difference in the way stewardship is understood by activist signatories has important implications for the signatories themselves, because it becomes clear that if you are a tier 2 signatory and you want to move to tier 1, and potentially you want to attract more clients, this is contingent on a more holistic, enlightened understanding of stewardship. So what can be learned from the UK and what can be learned from this study? First of all, it is clear that soft law stewardship codes are flexible and they're adaptable to changing circumstances. And if you look at the UK history of stewardship, you can see that between 1991 and 2020, there are 8 different stewardship initiatives. And that's not just the UK trend. There are also other countries like Italy, the Netherlands, and Japan, where there have been, where the stewardship codes changed to reflect the changing circumstances. That's lesson number 1. Lesson number 2 is that it seems that informal enforcement by market actors is probably the preferred option, especially when we're talking about market invoking regulation, but at the same time, some market steering is needed. And we can see from the differences in the signatory statements between tier 1 and tier 2 that being in tier 1 does make a difference. The third message is that the 2020 code and the emphasis on ESG is a step to the right direction and is in alignment with the way tier 1 signatories were already perceiving stewardship. And finally, the empirical findings confirm that hedge fund activism and stewardship are not incompatible, especially for tier 1 signatories. But of course, one needs to bear in mind that those statements are also aspirational. So more research is needed on the real outcomes. So these findings are even more important if one takes into account that stewardship codes now exist across 19 countries around the world. And on the slides, you can see a figure that we prepared as part of another paper with Matthias Ziems, where we studied the relationship between the different codes. And we found that the UK code is at the center of the stewardship network. And even though diffusion processes are too varied and too complex to be reduced to a direct one-way transfer, it seems that there is a strong evidence of formal diffusion among common law countries in Asia. So I suppose the question that Dan is going to address is whether behind this formal diffusion, there are renegotiations or perhaps constellations of stewardship at the local level. Thank you.
Thank you so much, Dennis. Can everyone hear me?
Yes, we can.
Okay.
Over to you, Dan.
I will just pull up my slides here. I'm a very boring guy who normally ends up being in bed at 10 o'clock, and it is 2:45 in the morning in Singapore right now. But I will begin. There we go. So I just want to start by really thanking Jeff for pulling this all together, the Milstein Center for organizing this, ECGI, and Elaine. They always do such a terrific job pulling these things together. And also a special thanks to the OECD. Really, this paper that I'm presenting with my co-author, also from the National University of Singapore, Ernest Lim, couldn't have been done without this terrific data from the OECD. And not only have they produced this wonderful paper, which we must cite 20 or 30 times in our paper, but they also shared with us unpublished data, which I'm very, very grateful for that. I guess Dionysia has set the stage very well for me, and there's not much to say about this. In 2010, the UK created the first code of corporate governance in the world. And then very quickly, codes started showing up everywhere in the world. And as Dionysia said, there are now 19 jurisdictions with codes on 6 continents all around the world. And the basic question that we ask at the start in the paper is we say, okay, these codes have gone everywhere. Are they the same as the UK code? And so what we did is very basic. but was a bit time consuming. We went through all of the codes. We read them. We tried to find equivalent principles. And there's a rather long section in the paper that tries to prove this in various ways. But to cut a long story short, you can see from the slide that it is very, very clear that the codes that have ended up around the world are very much a copy of the UK code. So the UK code has been transplanted in large part, with some minor exceptions, to these 19 jurisdictions around the world. And being someone who's sitting now in Singapore, this created a puzzle. And the reason why it creates a puzzle is because the code and what we call in our paper, creating a global legal misfit. And what is the misfit is, at the core of the UK code, there is an assumption. And the assumption is that if institutional investors act collectively, that institutional investors can control most companies. So the debate in the UK, and historically this has been the case as well, and in the academic literature, and in the code itself, there is an underwritten assumption that institutional investors have control collectively. But the question is, can we motivate them? Can we incentivize them to be active and to take control? But that assumption works also in the United States, but it doesn't work anywhere else in the world. And if you look at, there's two reasons why it doesn't work. The first reason has to do simply with the average percentage that is owned by institutional investors in non-UK countries. Now, if you look at the average statistics for the average listed company in the United States, 80% is owned by institutional investors. In the United Kingdom, 68%. So clearly in these jurisdictions, and this is why you get the famous phrase absentee landlords in the UK, was because they said, well, we have institutional investors that own all of the shares, but they're not doing anything to involve themselves in the corporate governance of the companies. And I don't use this wording in the paper, but I'm thinking of maybe putting it in there now, which is that when you get outside of the US and the UK, you don't have absentee landlords, you have absentee tenants. Because even if these people come together, they can't control the company. And if you look at the most extreme example is within Asia. In Asia, institutional investors on average in the Asian jurisdictions have 11% ownership. And you have several jurisdictions where they have less than, they have single digit ownership. So if they come together, they don't even have enough to form a blocking, a veto minority. The other side of the coin is that, different from the US and the UK, in most other jurisdictions in the world, listed companies have a large block shareholder. And I was actually surprised when we started calculating based on the OECD data, the dramatic difference, which is that, and you can see on the chart here, that the average company outside, or the average jurisdiction outside of the US and the UK, 61% of companies have either one shareholder or their top three shareholders that own 50% of the shares. Half of the countries outside of the US and the UK, 70% of their countries have such an owner. So these are rationally active block shareholders. So there's no problem with ownerless companies, or I shouldn't say no problem. Of course, there's some variation, but by and large, companies have rationally, or countries and the listed companies in those countries have actively or rationally active owners. And so the question then becomes, why do you need a stewardship code when you already have stewards? That got us to the next part of our paper, which draws hugely on this project that Dionysia first launch, and I've been riding on her coattails ever since. And this has produced in-depth reports on every jurisdiction with a stewardship code. And when you go through those reports, it's fascinating because you ask yourself, well, if there's such a misfit, why are these countries adopting a UK code designed for a system where institutional investors can take control? Why are they doing this? Why don't they draft a code for controlling shareholders? Or why are they bothering to implement these or adopt these codes at all? And I could go through story after story, but I don't have time. I'll just list off a few. The end result, though, is that these UK-style stewardship codes have been adopted in non-UK jurisdictions for reasons which would have never been anticipated by the people who drafted the UK code. And because they were adopted for those reasons, they've also come to serve these functions that you would never even think of. To give an example, in Singapore, and the details of all of this are in the paper and in the supporting papers, Singapore has adopted a stewardship code which largely serves to reinforce its state-controlled and family-controlled system of corporate governance. If you look at Korea, Professor Chan and Professor Kang wrote this terrific case study on Korea, and they say that critics in Korea have, they claim that the Korean government has pushed stewardship so that they can use the national pension shares and bring along other institutional investors to force them to sign up for stewardship to intervene politically in the corporate governance of companies. So this is a political motive that these critics call pension fund socialism. In Japan, Gengoto at Tokyo University has shown that Abenomics was the driver behind the Japanese stewardship code, and it was used to bring more shareholder focus, not stakeholders focus, to bring more short-term thinking, to cause companies to take more risk, not less risk. Again, turning the UK model on its head. Many other examples, a very interesting one, just because of what's in the news these days, if you watch the news on Asia and the protests in Thailand, the military junta in Thailand passed a stewardship code. It was very much modeled on the UK code. And you have to ask yourself that question as to why. What was the motive of doing this? It doesn't fit their shareholder structure, and you can see a political motive. Outside of Asia, you have a different story, which is that most of the codes are different from the UK in that they're not passed by governments, but they're put forward by a coalition of institutional investors. In those cases, the motive is normally quite straightforward, which is that institutional investors generally want to stave off the government passing an act, and they put out a code for that purpose to serve their interests. We then go on in the paper, and I'll move quickly because I know I'm short on time. And what we do is we say, okay, are there any jurisdictions in the world that have actually tried to tailor a stewardship code not to the UK model, but to the controlling shareholder problem and the shareholder makeup in most jurisdictions around the world? And indeed, there's only one code that has ever done this, and it's in Singapore. In Singapore, there's two codes, one for institutional investors and another one for family businesses. And we go through the code and we talk about how this is quite an interesting development. Another thing that you notice in recent codes, and this shows up, of course, hugely in the 2020 UK code, is a focus on ESG. And so we asked the question, well, can stewardship in a controlling shareholder jurisdiction, if it is drafted in a way to fit the system, can it solve the ESG problem? What we end up concluding, Ernest Lim and me, is that stewardship will probably be one tool, a weak tool in controlling shareholder jurisdictions. We're not overly enthusiastic about it, but we suggest that mixing it with hard law may not hurt. It may be somewhat useful. It will be one tool in the toolbox. We definitely suggest that in the future, if you are going to understand stewardship, you are going to have to understand it in controlling shareholder jurisdictions. Why do we say that? Because that is the state of the world outside of the US and the UK. And just to end, maybe on not the most positive note, our feeling at the end of the day is that what the future will hold for stewardship is that in more jurisdictions, institutional investors will come together, especially in the time of COVID and post-COVID. They will want to express or to be seen, to be taking care of ESG, taking care of society as a whole. Governments also will feel this pressure. And stewardship is a cheap, malleable, easy to copy instrument that is soft law, and we're probably going to see more of these codes. What we say will be needed to solve the heavy lifting or to do the heavy lifting in controlling shareholder jurisdictions is a focus on hard law, not on stewardship. And we are skeptical whether these hard law fixes will be put in place, because after all, the so-called stewards in controlling shareholder jurisdictions are the state itself, wealthy families, wealthy individuals, and those people tend to be very good at preventing regulation that ends up biting them. So a lot of bright lights, but little bite at the end of the day. Thank you very much.
Thank you, Dan. Mats, we are running already a bit late, so straight over to you.
Very good. And to Paris, and thank you very much again for having me, and to the Milstein Center and ECGI, longtime friends of mine, and very valuable sources of research and debate on these issues. I should say that I would speak in my personal capacity, so all I say is not necessarily shared by the OECD or its member states. As you can imagine, I am very pleased to see a data-driven, empirical-based paper, and this is very much in the spirit of the OECD. And I think you've also made very good use of the work by my colleagues Alejandra, Adriana, and Yun. And this search for knowledge is the starting point, I think, for any good discussion. And the knowledge that we need more than anything else for today's discussion about stewardship is knowledge about the ownership structure, and most importantly, the incentives that comes with the ownership structures and the business models of the different intermediary owners. And by this, I mean not some sort of abstract incentive of an organization, because in a sense, business organizations do not have incentives. People have incentives, individuals have incentives. So my proposition would be that the behavior of organizations is sort of the lump sum, in the sense of not of declarations, but of the incentives of the people that populate these organizations. So right there, going back to Rebecca Henderson's emphasis on a collective action problem, we actually have a collective action problem even within our financial institutions. I don't think I've ever seen I mean, it has to do with remuneration structures, bonus systems, incentives, etc. And I don't think I've ever seen anybody voting proxies being able to retire comfortably at the age of 37. But I have met, and I have friends in the fund management industry who are asset managers who have, and some of them didn't even know at the time that they retired that they had a corporate governance department in their firm. So I think that says a lot about what's actually is going on in the industry if we take a bit of a look under the hood and look at the different incentives and remuneration structures that actually drive the real behavior. And once we understand this, I think we will also realize the difficulties of translating the wish for an indexer, as Lucian said in the morning, their wish to be perceived as a good steward. The difficulties of translating this actually into practical, good, and informed ownership and stewardship that actually costs a lot of money. So I think the practical effect, and this is what a stewardship code is up to in reality, if you want. I mean, you may write these things on the paper and then you're confronted with these incentive structures and business models of the institutional investors, which themselves comes in different shapes and forms. I mean, it's an asset manager, a pension fund, a public pension fund, a private pension fund, an insurance company, what have you. I mean, they all have different business models and different incentives when it comes to engaging in stewardship and investing all the money that is required to do it well. And this is what the codes, in a sense, are up against, trying to herd in one direction. And I think that for practical purposes, this is a bit like Dan's picture as well. It's like fitting a square into a round hole. It will just not work out as intended. So what is the problem then? Is there a problem? Couldn't one just be agnostic about these stewardship codes that are proliferating around the world? Perhaps one could and say let them put them out. You know, it engages a lot of people to draft them and discuss them, etc. Even generates some good academic work. But I would say that there is actually a potential downside, because if the political pressure or the social pressure, in a sense, to comply with these stewardship codes becomes too high, we may turn into a simple compliance, boilerplate, box ticking exercise. And this can indeed have adverse effects on the need for developing idiosyncratic new arrangements in individual companies. I would say, particularly with respect to companies that operate in other legal contexts than the asset manager is usually familiar with. And you know as well as I do that there is more than one testimony from national asset managers being horrified by large global asset managers who are voting against their own interests just because they don't understand the local context in which the company operates. When we developed the OECD principles of corporate governance in 2000, between 2013-14, and they came out in 15, there was also this discussion about the role of institutional investors, and we actually inserted a whole new chapter about institutional investors, and the discussion about stewardship came up, and whether there should be some stewardship code, recommendations, etc., from the G20 OECD. But what our member states actually did was they stopped short of this quite explicitly, and they even, and I think I'm quoting when I'm saying that the current version of the principle says that whenever shareholder engagement is not a natural part of a shareholder's business model and its investment strategy, mandatory requirements, for example, to vote, may indeed be ineffective and lead to a box-ticking approach. So I would say that there is not only a lot of perhaps false expectations and misdesign of these stewardship codes if you don't look at the incentive structures, but there also could be a bit of adverse effects when it comes to their implementation. Because what we are trying to do in a sense with the stewardship code is to transform an animal, or rather a big variety of animals that we call intermediary investors. And as I said, they come in different shapes and forms with different incentive structures within themselves. I mean, we're trying to transform them into something that would look like the original Burley and Means direct investor, if you want, and have the same incentives to engage, et cetera, et cetera. Maybe the door has closed when it comes to that ambition. Maybe what we should do is to look forward to new solutions as corporate organizations change, as capital markets change, as the functioning of our equity markets are changing. And there could be a number of developments that and rather than sort of petrifying the system in this mold and dream back of a time when shareholders were supposed to be directly engaged and put a lot of attention and scrutiny into individual companies, maybe we should at the same time make sure that we have the door open for new versions. And I think this is for new idiosyncratic models for corporate governance. And I think this is already happening. I mean, if you see a lot of the new technology companies that enter the stock market at a fairly late stage, well-funded, etc., they do have different governance structures, if you want, than the traditional corporate governance model. And investors very much seem to accept this. So I think I'll stop there, Marco, and give the word back to you.
Thank you, Mats. So, Mariana, the view from Brazil, the country with the most controlling shareholder-friendly corporate law regime in the world. The floor is yours.
Working hypothesis, Marco. So first, thank you to Jeff for this wonderful invitation. Congratulations to the Milstein Center and ECGI for putting together this great event. I must say that in the early stages of my career, I had the great privilege and honor of working together with Ira Milstein, both as a junior lawyer and researcher at the Milstein Center. So it's very special to have the opportunity to speak at a Milstein Center event. It's also a great privilege to comment on Dan's and Dionysia's great paper. So my comments will focus on the question of where do corporate governance developments come from? We all know they can come from domestic needs and dynamics. They can also come from foreign jurisdictions, and this relates to the theme of legal transplants in comparative corporate governance, which is actually part of the title of Dan's paper. But I'd like to highlight also the international dimension, and that relates perhaps to Mats from the OECD and also from other international organizations and standard setters, and their role, which is often neglected in pushing for corporate governance developments. So beyond Dionysia's great work in distilling the text, I want to talk a little bit more about the context and specifically about what I call the rise of international corporate law, or what perhaps Jeff Gordon would call the global governance by asset managers. So let me give one example from Dionysia's paper. She notes in the paper, although not in the presentation, that from the 15 out of the 19 hedge funds that signed up to the Stewardship Code are also signatories to the UN principles for responsible investment. from the United Nations originally. So one question is, how does the stewardship codes commitments relate with this other, perhaps even prior commitments to the PRI? Some would say that actually the PRI were the first initiative on shareholder stewardship, even prior to the stewardship code. Beyond that, and that relates also to Dan's paper. So Dan tries to make sense of a global transplant of a legal misfit. Dan is a great comparative corporate governance scholar in the tradition of being a splitter. Jack Coffey from Columbia says that some people in corporate governance are lumpers, so they see common patterns across different jurisdictions, and some people find distinctions across different jurisdictions. And Dan is a great splitter, and he's doing a beautiful work in this paper in showing the very dramatic importance of ownership structures in understanding the power of institutional investors and therefore the potential effects of stewardship codes. And he wonders, why did those countries adopt stewardship codes if they were tailored to the UK's reality of dispersed ownerships, as we no longer live in colonial times when a country would just impose its laws on another jurisdiction, and the decisions of governments around the world to adopt UK-style codes even appear to be irrational. And I'd like to give greater context to this idea and perhaps offer some mild pushback. One idea is that actually international corporate law might have played at least some role in the diffusion of legal transplants, and I actually think both Dan and Dionysia to pushing me to investigate the impact of international institutions in the rise of stewardship codes. And I noticed that for various countries, the World Bank's reports on the observers of codes and standards actually explicitly recommend countries to adopt stewardship codes. That was the case with respect to the assessment for Brazil, and lo and behold, a few years later, Brazil adopted a stewardship code. So there might be growing international pressure from these international organizations and standard setters to adopt those codes. The G20 OECD principles do mention stewardship codes, even though they don't necessarily mandate it, but the expression is certainly there as one policy option for countries to consider. And then there's the question, why is it that those international organizations care about stewardship codes? And here I want to offer two interpretations. One is that international organizations have played a role in resisting what I call the grip of nationalism on corporate law, which is the idea that countries might want from time to time to expropriate or perhaps not be exceedingly friendly to foreign investors and instead try to favor domestic parties. So certainly stewardship codes place a pattern of legitimacy on the role and ambitions of institutional investors, which might be helpful in an international corporate governance perspective. And the second idea is the growing push, which actually originated in the international sphere. ESG come from United Nations initiatives to use corporate law and corporations and global investors to solve many of the world's most pressing problems, including addressing externalities, and that is important because the externalities are real, and they are real economically, and perhaps that's a key part of Jeff Gordon's paper, and also they are real in creating political backlash against corporations and globalization, and perhaps even capitalism, so that it is important for investors to buy in greater legitimacy. So I'm offering those perhaps complementary interpretations to the rise of stewardship codes. And In Dan's honor, I also want to offer some further splitting. Okay, so Dan said dispersed ownership is different from concentrated ownership. I get it, and that's a fundamental distinction. But it's also the case that not all countries with controlling shareholders are alike, and there might be actually particular corporate law rules for which stronger institutional investors supported by stewardship codes might make a difference. And I'm thinking here, for instance, about countries such as Italy or Brazil, by which the law recognizes board representation of minority shareholders as a general rule. Also, for those countries that at least in some contexts require majority of the minority approval requirement for related party transactions. In those contexts, it would be very helpful to have active and engaged and informed institutional investors, even though you might have a controlling shareholder. And just finally, it is the case, as Dan suggested, that certainly around the world, outside of the US and the UK, you have a majority of controlled firms. But even in the United States, today we are in a context in which we see the very largest firms having, and I'm thinking here about many of the technology firms, in fact, having controlling shareholders as well, and creating, I think, very important ESG issues, as well as issues of broader legitimacy that might interact in interesting ways with the promise of stewardship codes and institutional investors to solve the world's problems. Thank you.
Okay, so we turn to Fred in a second. Fred has slides to share. So let me just maybe add one comment to what Mariana said. I mean, if you go back to the original paper by Black and Coffee about the UK, Hail Britannia, they have a very compelling example in there that although you at the time still had controlling shareholders in the UK, because of the rights issues rules, actually a minority could go on a capital strike. So the fact that companies needed to raise capital and minorities being able to block that desire of the controlling shareholder actually gave them influence. So the voting channel is not the only way in which a coalition of shareholders can gain influence. But turning to Fred, so when I first read the papers of Dionysia and Dan, one of the facts that you document is that the stewardship code, in fact, has been exported mostly to former colonies of the UK. So that reminded me a bit of Marmite. It is something that you like or you don't. And actually, as a matter of fact, those who like it, outside the UK are those in the former colonies. So I think what Fred, has for us is a different view. He, of course, works at Amundi at the frontier of reality. So first of all, I think Fred will argue that actually reality has overtaken us from the left, or if you drive in the UK, from the right. And secondly, that of course, Bon Maman is a much better export product than Marmite. We just haven't realized. So Fred, here you go.
Yes, due to the Brexit, I could not comment on the UK stewardship. You can understand that. So thank you to you, Marco, and Jeff for the invitation. Today, I will focus on 3 topics, actually. Climate change, tipping point, and new responsibilities for investors. Climate change is a green swan. It means that it's very likely you have multiple forces behind climate change that are nonlinear and interacting with each other, meaning that it's extremely complicated to price the risks, like Theresa said before, and it's putting human life at risk. So it means that here we are facing, in terms of risk management, with a massive systematic risk. That's the bad news. The good news is that since the COP21, everything has changed. We have observed that multiple forces are getting aligned and generating a tipping point. And part of this tipping point is the fact that we have a massive wave among the institutional investors. And beyond that, we see more and more market players playing the usual objectives of stewardship quotes: control, wealth creation over the long run, and influence. So we have a massive risk, but the world is waking up. Now, however, in terms of climate change, stewardship certainly goes beyond the usual objectives, and we see more and more players who are aiming at improving the market resiliency, and it will be my third part. So before that, in order to deserve the kind introduction, a few words about what brings me here. Actually, 10 years ago at Columbia University, in partnership with Professor Bolton, I launched an academic center dedicated to sovereign wealth funds and how they could internalize, could or should internalize some externalities like climate change. Later, I launched the first coalition of investors committed to decarbonize their portfolios with a $800 billion commitment. I initiated some financial innovations. I advised some policymakers like the US Senate. I testified before it last March, and I published a couple of papers. So now when we talk about climate change, we are facing an unprecedented challenge. We, the planet, we are producing about 40 gigatons CO2, and we are on the way to double it. We have more and more people on Earth, good news, escaping from poverty, better news, and so on. The problem is that if we follow that path, half of the humanity is at risk, as we will see. So we must shift from doubling the emissions to cutting to almost zero by 2050. We have never faced that. It means that all countries, all sectors, all corporates will be impacted. Is that to be in a very nice and coordinated manner? Maybe. But more and more people have very serious doubt on that. So the magnitude of the problem is unprecedented. And if we fail, it means that at the end of the century, half of the planet will have to move because they will be at risk. Here you have the situation of the deadly threshold per year in terms of number of days. It means that you will not be able to live in Brazil, in South America, not in Central America, part of the US, no more in Africa, no more in India, Indonesia, Australia. So here we talk about human lives being massively at risk. In terms of asset prices, it's not so easy as well, because you have at least 3 blocks of forces impacting asset prices. I won't be long on that, but you have society like millennials that are changing their consumer preferences. You have regulation, they are booming everywhere. Last year, the price of carbon tax has been multiplied by 5 in Europe. And nature, we had over the past 40 years, the number of extreme weather events have been multiplied by 4. By 2050, about 50% of the world population could be at risk in terms of water scarcity. And the problems here is that all these forces are interacting with each other, and most of them are non-linear. So it means that you have a lot of uncertainty and risks on the asset prices. So that leads to a green swan, a term that we coined with the BIS, the Banque de France, and Patrick by publishing a book earlier this year, saying that certain carries a variety of nonlinear and interacting risks and could put human life at risk. That risk cannot be hedged. That risk goes beyond a corporate investor's way of being solved. As Patrick said as well, we are all parts of the answer. It's not about a miracle solution. And it's so big that now 65 central banks, including the Bundesbank, central bank, the Bank of England, Banque de France, Singapore, MAS, and so on, they're all putting climate change on the agenda because they recognize that it threatens financial stability. So all investors are now facing that reality. That was the bad news. The good news is that everything has changed over the past 3 to 5 years. And that's a very short period of time. We have to think about that. Climate change has been on the table for decades, and nothing was happening. And suddenly, around the COP21, everything changed. 3 to 5 years ago, we still had some deniers. They have disappeared, but at the White House. It was one of the many risks. Now it's the biggest risk, as mentioned by Davos. You had very limited regulations. Now they're booming everywhere. You had no global agreement and no hope of having one. We got the COP21 here in Paris. China was blocking. Now China is leading. You had a very limited interest within populations. Now it's a top priority for millennials. It was for economists only. Now we can observe in our day-to-day lives. The cost of renewable energy was very high. Now we have very competitive pricings. You had very few European investors. Now world investors are jumping in. And it was a progressist agenda. Now it's in the agenda of central banks. What this slide says that none of these forces is enough to get an impact. But when suddenly they're all getting aligned, then you have a tipping point. That is exactly what we are observing now. It's a fantastic good news. In terms of investors, what does it mean? It means that suddenly we have a responsible investing tsunami. We have now $30 trillion of responsible investment. And Deutsche Bank estimates that it will grow by 50 to 45 trillion plus 15 trillion by the end of next year, and to represent even $125 trillion by the end of 2030. It's still confusing in terms of terminology and so on, but it says something. Now, in terms of influence, one of the key objectives of stewardship codes, and I could have spoken about votes, I could have spoken about PRI and so on, but I focus on influence. And I would like to elaborate on something that was not so much discussed today, because we discussed a lot about the hurdles that investors could face by cooperating and influencing. But actually, Campus at the One Planet Summit here in Paris in December 2017 launched the Climate Action 100. And now it gathers 500 investors representing $47 trillion. That's an enormous amount of money, $47 trillion. And they are engaging with the 160 most polluting companies. And when I say they are engaging, they are doing something very serious. Here I copied the joint press release that Total and Climate Action released. They say, we discussed together, and here is a new policy of Total. So they were concretely able to influence one of the largest oil companies in the world about their climate policy. Now, so we see that the investors are getting mobilized. They are trying to influence corporates. Much more can be done, but there's a momentum. But to conclude on this presentation, I would like to highlight something that Rebecca highlighted briefly with Hiro Mizuno, who has exactly the perspective I will describe here. He said, being a universal owner, I think, says Hiro, that part of my responsibility is to improve markets' resiliency. So it's not only to get returns that will disappear when there will be a crisis, is to make the markets more sustainable for the benefit of my beneficiaries. And I would like to highlight two case studies where investors pushed for innovation. Case study one, a couple of years ago, AP4 and then FR challenged us, and they said, okay, we got convinced on low carb, on climate change. Can you develop a low-cost, plug-and-play, scalable solution to reduce climate change-related risks? And we developed the first low-carbon indexes with their support. They allocated some resources, financially and intellectual resources. And it's now a 50 billion market. And by the way, it tackles many of the issues that were discussed today in terms of index and so on, or passive management and so on. Here, you reduce the weight of polluting companies within indexes. And the very good news is that actually it has delivered more than 30 basis points of outperformances since over the past 10 years. And you have a paper and a case study at INSEAD. Another case study about how to finance some green infrastructures in emerging markets. Here, IFC played the role of allocating some resources, developing a prototype that became available for the others, and suddenly we could deploy $2 billion and allowing a better allocation of capital around the planet. And it's a business model being replicated by AIB and AIB. So what I'm saying with this 5 investors. They said part of our duty is not only to make returns, but to improve market resiliency for the benefit of all. And I think it's a very interesting trend here. And it's part of the message that Patrick carried before, meaning that we are all part of the solution. We cannot count on a miracle solution. So to conclude, the world has massively changed over the past 5 years. The bad news that climate change is a systemic risk, even putting human life at risk. The good news is that you have a global mobilization, including a massive wave among the investors, that market players are achieving the usual objectives of stewardship codes, control, wealth creation, and influence. Stewardship codes are important. They're helping us shift from first movers towards adoption by all. But now, with this very specific risk, that is climate change, that is putting human life at risk, that is the biggest challenge ever faced, we think that stewardship goes beyond the search for alignment between shareholders and corporates, and it includes a will to have markets being more resilient. It's a call for financial innovation, and that's maybe a new utility function for public money.
Okay, so we're almost out of time, but I'll ask you one question based on what Fred said. So I think Fred's argued that, remember, France is called La Grande Nation, okay? So this is the view of we cooperate, this is the big stuff. We have this global investor coalition, people are really behind this. And it resonates a bit about, with what Rebecca Henderson said. So Dionysia, Dan, Mats, are you convinced, was this a convincing argument that this new wave, this new commitment, COP21 and everything else that Fred has said, is this basically putting stewardship codes in perspective? And yeah, they're a tool, but this new development is just sweeping it away, and we can be actually a lot more optimistic than you said. So Dionysia, Dan, and then maybe Mats from the OECD perspective. I mean, does anything that Fred said resonate with you?
I think it was John Maynard Keynes who said that optimism is the highest form of intelligence. So I like to be an optimist, and I also believe that all decks on hands, because everybody can do something in this very urgent matter. I think we do have a collective action problem. I believe that both with Leo and with Rebecca, that there needs to be regulation in place in order to get the relative prices of different things in shape, so we can have a carbon tax and actually have polluters pay. I think these are important OECD perspectives. Second, I believe that there is one thing that is important for this to work, because for Amundi and for others to actually achieve what they want to achieve in terms of change and in terms of impact, there needs to be indices and there needs to be ratings that actually reflect what the companies are doing. And we just recently, last month, put out what we call an OECD Business and Finance Outlook that was dedicated to sustainable finance. And one of the things that we highlighted in our findings was that there is quite a mismatch between what these indices promise and what is actually delivered, particularly in the environment area. Second, the ratings that we see out there, and this is all well intended and we are still early days, are also sometimes even contradictory when it comes to the kind of scores that they provide. And of course, very shortly, Marco, one of the problems is that we bundle all these ESG together. I mean, governance is probably 80% of what corporate governance is all about, right? And how do we weigh them between each other and call them all ESG? I mean, I'm personally a bigger fan of not using the ESG concept, but actually splitting them up. I mean, is shareholder, the structure of a shareholder meeting, how do you weigh that against carbon emissions, for example? It doesn't come natural to me. So I think that if we talk environment, we should talk environment. If we talk corporate governance and differential voting rights or whatever, we should talk about that. But bundling them in one index doesn't make much sense to me, to be honest. What is needed to bring some clarity to this and help the institutional investors, helps the index providers, and help the ratings agency is to have some sort of trajectory towards comparable, consistent, and verifiable disclosure variables on this. And I know that IFRS just recently indicated the first step towards working towards this. And I think before we have that, we should all do our very best, but we should also get to a place where we can give those that want to achieve some good results the tools to actually do so.
Okay, I was going to ask Mariana about Petrobras, but I'm out of time. So let me just thank the panel. And before I hand over to you, Jeff, for your concluding remarks, let me just say that I think we finished here on a note of optimism. I think we heard last night that at least one of the US presidential candidates is committed to an energy transition in the US. I think we heard from throughout the day today that at least the people who participated today are very much in favor of international cooperation at all levels to solve the questions that we have in front of us. And I certainly took all that optimism away from today's meeting. And I think, Jeff, you said it at the beginning, and when you first contacted us about wanting to put together this event, this was your intent. And I think it's come through very loud and very clear. And I'm very happy that we finished on this bullish note of optimism from Fred that I think echoes also with what was said before. Now, I of course thank you, Jeff, but Elaine has also sent me a little note. But of course I have to thank her, but you can do that again, Jeff. So first of all, I want to thank you for putting this on at short notice. And then, of course, to thank the team at the Milstein Center, so Erica Klein, Brea Hendricks, and Chris Mack for putting it all together. And of course, for your initiative and kindness, and for being such a great colleague, Jeff, and for leading all this initiative and for involving ECGI. And it's always a pleasure to work with you and the Milstein Center. So thank you. And thank you again to the panel. And thank you for Tunisia and Dan for a great paper. Thank you.
Marco actually, well, first, it's always a pleasure to work with the CGI because Marco and Elaine are so able at what they do, and Marco over time has become a master overseer of all of these activities, and he himself has played a very important role in maintaining the global governance debate, which I think is very important because these issues have a global dimension. Many of them, obviously, the climate change issue is, of course, global, but many others we can't solve really unless we think about the world as a whole. So, but I don't want to, I've said what I have to say really, and Marco really gave thanks to the relevant folks, both at the ECGI and the Milstein Center, who did such great work in bringing this together. I'm mindful of the fact that at 3:40 in New York City, it now is almost 10 in Paris, and in Asia,
Jeff?
I'm not sure what it is. So so this has really been a testament to the desire for folks at this time of interference with the normal ways that we get together, to hold fast to the ideas of discussion and thinking with one another. And it is good to end on an optimistic note, both with the hopes that we will soon have a vaccine and therapeutics that will permit us to re-engage in a personal way when we can all be in the same physical space. But also,
And you know, Jeff, this is Mats.
Yeah.
You know my level of dedication? You want to know my level of dedication?
Yes.
Because we are under a curfew here in Paris, right? And my daughter sent me a text message saying, "Dad, when are you coming home?" And I said, "Well, around 10 o'clock. And she said, "Well, don't you know there is a curfew from 9 o'clock? You can't walk the streets." So here I am in the office. I'm going to spend the night here. I have a good kettle. I have some Nescafe to cater to. But it's been worth every second of it. Every second, Jeff. Thank you very much.
Well,
thank you.
That now that truly is above and beyond, right?
If I get picked up by the police on my way home, I'll send I use you for a lawyer.
Yeah, well, we can at least send sort of a note, sort of like potential very good excuse. So anyway, I was about to say, so I hope it's not only the optimism that comes with the thought of a vaccine and maybe the therapeutics that will shackle us from this particular mode, but also I'm optimistic about a dawn of new politics in the United States. And with that, I hope chance to re-engage the world in a different way. The challenges are very important. So anyway, I hope the day has been successful at rethinking stewardship. And for those who are still online, and we're in 3 digits. The plan is to have videos from the day. We're going to try to edit them, I think. There will be, the reporters are going to write up discussions of each session. I hope to be able to get the slides of the speakers. And so the idea is that folks who want to reflect on these further will be able to do so, but also for the academics in the audience, there is a lot of material here, which I think would be great to run a class discussion, maybe a workshop. And so that's part of the reason that this kind of event is important. It's not just a discussion for those who happen to be in the Zoom room, but we hope we're going to create externalities of public good that can be exploited further than just this time. So with that, I think I will say goodbye, and with great thanks to the ECGI staff, the Milstein Center staff, with whom, I mean, it just went off so well. I mean, I sort of remember, excuse me for a minute, but back in March when there was a global thing that the GC put together, we weren't quite sure that this thing with Zoom would work, right? That we could manage to have folks coming in and out to hold it together from all over the world. And now we've become quite experienced at it. I hope this is a skill that will die in its use over time to some extent, but nevertheless, it's a great way to bring folks from all over the world together who may not be able to get into a plane to be in the same time, in the same space. So thank you very much. And I guess it's time to call this to an end.
Thank you very much, Jeff.
Thank you, Jeff.
And I should also thank you to Vanessa Koenig, who also worked on
yes.
CGI. And the next thing, Jeff, of course, will be 3D meeting conference software. And I'm looking forward to seeing what you look like as an avatar. So thank you.
All righty. See you guys.